Everybody present here. I welcome you to today's session Income Tax 2.0. So today we have three speakers along with us to present this session. So first I would like to welcome CA VENKATARAMAN sir. Sir, please talk with the desk, sir. Thank you. Thank you, sir. I also request the members to rise up for the motto song before we begin the session. Thank you.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Before we begin the session, I would like to give a short summary of VENKATARAMAN sir. So CA VENKATARAMAN sir is a fellow chartered accountant, member of CPA Australia, and has 9+ experience in practice and employment. He is currently specializing in international taxation, corporate compliance, and risk consulting. Beyond his remarkable career, he is also a faculty for CA, CMA courses, and also handles seminars and sessions in various forums, and have received various awards and achievements in education and profession. He is also a visiting faculty for intermediate and final students. On behalf of SIRC, sir, I welcome you for accepting our invitation and taking the time with me to us today. And also to show us gratitude, I invite CA Krishnasamy sir to present a memento to CA VENKATARAMAN sir as a gratitude and respect. Thank you, sir. Thank you, sir. I now request CA VENKATARAMAN sir to take over the session. Thank you, sir.
Om Shri Gurubhyo Namaha. Very good morning to everyone. So, first of all, I would like to thank Vishnu for giving a brief introduction about me. And as he was mentioning, I am a faculty for past 4 to 5 years. I have handled various batches of students in CA and CMA. In taxation, accounting, etc. But I would like to start the session with a small confession note that this is my first CP session to handle the session here, and it definitely gives me a immense pleasure and privilege to be here in front of the august audience of knowledged members here. And the topic given to me for the day is on the evolution of income tax. First of all, I would like to, I have noted something on the poster. It was mentioned as income tax 2.0. I definitely have a doubt whether it is really a 2.0. Whatever the new bill presented by our Honorable Finance Minister is a new version of income tax, but definitely I don't think it is a 2.0 version. It is more than 2.0, and that is what I am trying to uncover here. What was the history of income tax which we had in the past, and where the concept of income tax was emanated, whether it is our own concept or it was a concept borrowed from any outside countries. So that is also we'll be seeing, and I will also be touching upon our own scriptures the Puranas and all those things, because the existence of tax system was always with us in our past. So that is what the brief coverage of this session. And definitely I will not be much touching upon the knowledge, that is the provisions of the current income tax. No, that is not the topic I will be, and definitely the people sitting here already have a good knowledge about the current income tax system. So what I will be covering is something which I can able to add some value to your knowledge about the past of the income tax. So we all know at present income tax is a mandatory levy, right? So everyone, there is no option. We cannot exercise, or we cannot contest to the government and say that no, I don't feel like paying taxes to you. That we all know. But we will be seeing whether it was the same position even in our past, whether in the past also, whether in our past also, whether the income tax was a compulsory levy. That also will be looking at today. We all know, and again, taxes, even though the session focuses on income tax, but the taxes are there, direct tax and indirect tax, and it had been there even from the past. Both taxes were there. I would say initially India was having, India, maybe that time we were called as Bharat, the time when I am speaking. So that time India was having indirect tax in the beginning, then slowly direct tax had come. The roots of present tax system, as I was mentioning, the tax system which we are following does not, it's not been borrowed from any outside countries. It was there from our own very much own scriptures, and the earliest act, the earliest law which the land we are living in had was the Smriti. Smriti refers to act, we all know that. The Smriti which our Manu had given us, right? So Manu Smriti. So the reference we will be drawing from the Manu Smriti. Manu Smriti had a detailed chapter. Okay, Manu Smriti was giving law for various things. It's not like specific for taxation. It was giving law for everything, starting from the human living, social social living, community living, individuals, goods, bad, whatever, the ethics, whatever we are talking, the various law were all having its roots from Manu Smriti, and income tax was also having the reference from there, and chapter 7 of Manu Smriti gives a detailed knowledge about the income tax provision. If you take the Manu Smriti text on one side and income tax law on the other hand, you can find a lot of similarities appearing between this Manu Smriti and as well as the current income tax system. And we cannot avoid the reference of Artha Shastra when we talk about our own income tax system, because Manu Smriti was like constitution which had a very narrowed references of each and every item. It was very vast. It was having everything into it. Artha Shastra, which was given to us by Kautilya, he also called as Chanakya. So it was almost like 300 BC, 2300 years backwards from now. So that Artha Shastra is predominantly on economics, right? The various rules and laws of economics, and one among them, it had a taxation system also in it. So Chanakya was living in the Maurya Empire, Maurya dynasty. So that time, that references also we'll be looking at today. And we have our own itihasas, famous itihasas like Ramayana and Mahabharata. It also had references about income tax in it, the taxation or income tax in it. So that also we'll be looking at today. And we know that taxes are primarily levied to have a better social living, so welfare of the society at large. Okay, one person who's the guardians of the society, which we call it as the government. Government takes in charge for the social welfare, and it is definitely the tax will help their position to give to do good things for the society. And the word tax was one side it was mentioned as the tax is referred from the word taxation, which means estimate of something, and it also has a reference from the Latin word of taxo or taxare. It also refers to assess something, estimate, assess the worth of some item. So that's where the tax word was brought to the usage. As I was mentioning, formal tax system, that was a formal tax system. The Arthashastra which I am referring was a formal tax system, like an act which was appearing at the Mauryan Empire to the 300 BC. And at that point in time, we were paying, in general I am referring to, we were paying taxes of 1/6 of our income. Okay, that was the rate which was having at that point in time. So the Arthashastra was not only mentioning about taxes, it was also mentioning at what rate the tax has to be levied. Right, like GST, which we are having currently, GST, customs law, which has rates based on the HSN code, right? HSN and SAC. That's what we refer for taking rates under GST and in customs law. That Arthashastra had a similar type of system, which it was giving different rates in case of income tax, in case of customs duty, in case of toll tax, in case of octroi duty. There were various taxes at that point in time, and it was also giving rates for each and every item. For example, agricultural produce, what was the tax has to be made. Land, other revenues from land, what is the tax rate has to be charged. For animal income from animal breeding, or so from that side, what was the tax rate? So the rates was also available in the Arthashastra. So that is also available. So with this, we have come to know that the taxation system was not a imported one, right? It is our own system which we follow today. But the act, the formal act which we are referring, the scripts of the formal act unfortunately had many references from the foreign laws. But if the people, lawmakers at that point in time, had referred to our own Shastra, that is Arthashastra, maybe they could have come up with the fine-tuned version which we are trying to go ahead, right? We are trying to fine-tune our income taxes by the various versions. We would have reached that level already. So that is what I would like to state here. So since it is a Puranic reference, I will also like to bring the shloka from the Puranic references for you to have a real taste of what was our earlier tax system. So as I was mentioning in the Manusmriti, where the taxation was referred, the shloka goes like this: Kraya Vikraya Madhvanam Bhaktam cha Saparivyayam Yogakshemam cha Samprekshya Vanijo Dapayet Karan. So here it says the king has to draw taxes like how a leech, a cattle, and the other animals like bee, how it takes food slowly, one by one. That's how the king has to draw taxes from the people. It should not be burdening the people. And it also the system also has to allow the people to come forward voluntarily and pay taxes. They should be happy about paying taxes. It's not that the taxes should burden them. That is how the taxes has to be charged, is what referred in the Manusmriti. And the famous scripture Raghuvamsha, in which our Saint Kalidasa had referred tax system as Prajanameva Bhutyartham Satabhyo Balim Agrahit Sahasra Guna Mutsrishtam Adatehi Rasam Ravihi. So it refers to, very simple, the king will take money from the people, right, for their welfare. King will take money from the people for their own welfare. How it has to be, how the welfare has to be provided. It has to be provided in the same way how sun takes moisture from the air, collate it, accumulate it, and showers it like a rain. That's how the good welfare measures has to come from the government or from the kingdom by taking taxes from the people, right? So that is what the taxation system was referred in our earlier scriptures. We all know what is the present system. I am not getting into those those things right now, because you are all already aware of what is the present system and how it is being deployed for the people's well-being. Again, going back to the reference on the Arthashastra, it says that the very famous line on the Arthashastra, it is dubbed in English here. From the treasury, the government's power comes from the treasury, right? And the treasury has to be taken through the means of army and collecting the treasury, like collecting taxes as well as from the army. That is how the Arthashastra had referred. We all know that people those days kingdoms used to get they were making some invasions to other kingdoms, and by making invasions they will get their wealth of that particular kingdom, and that wealth will be again deployed for the welfare of the people of that kingdom. That is how it was taken, and the treasure was collated in that way. And the taxes or the earning of the government, we all know. What is that earning? What is the role of the government as referred in Arthashastra? The government is actually doing their duty of protecting the people and doing giving a better life for the people. For that, the government has to be remunerated. So that remuneration is tax. The remuneration again will not be consumed by the government. The government will consume again back for the people. So that it will go from one side, again come back to the people on the other way. So that is how the circular system was referred in the Arthashastra. So again, it also refers that the taxation helps the government to run the administration as well as spend the money on the essential public services like education, health and infrastructure, etc. So as I was mentioning, it is not only talking about tax as a single line item, it is talking about multiple types of taxes like income tax, octroi duties, toll tax, customs duty. All that was available in the Arthashastra, which is what I am referring. I have already referred 2300 years ago. And the people who know a little of history knows that what the other countries were doing. The people of other countries were doing at that point in time. And the civilization we were talking about in 2300 BC, that is 300 BC, we were referring to the taxing system. So that is how rich our heritage is. Again, as I was mentioning, the two itihasas, only two itihasas which we have is one is Ramayana and second one is the Mahabharata. Obviously, the reference was available in case of Ramayana and Mahabharata. And in my first slide, you would have noted that I have mentioned that the tax was paid at 1/6 of the income, 1/6. This rate is actually available in this sloka itself. Bali Shat Bhaga. Okay, 1/6. Bali refers to the tax. Shat Bhaga refers to 1/6. So Bali Shat Bhaga Mudritya, taking, collecting. Nripasya Rakshitah Prajaha. Nripasya, the protector, the government, the kingdom, the king. It protects the people. Rakshitah Prajaha. Adharmo Yosya Sosyastu Yasyar Yonumate Gataha. Actually, the second line is not relating to the taxes. If you understand the context of the shloka, it was on the context that when there was a war in the Kaikeyi, that is Kakatiya Desha, that time when Rama was sent for exile to the forest, that point in time Bharata was not available nearby. Okay, and when Bharata came back from his war after completing it, that time he learnt that Rama was sent for exile by Kaikeyi, right? So that reference was that time the shloka had come. It says that the people, the king, even after taking 1/6 as taxes, which is meant to protect the people, he had sent Rama in such a way that the people become unprotected now. So that is what the reference of this shloka was all about. Again, coming to the Mahabharata, Bali Shashtena, here also it is 1/6. Bali Shashtena, Shulkena again toll tax, Dandenatha Paradhinam, Shastra Nitena Lipsetha, Vetanena Dhanagamam. Again, I will make a context for the shloka, because since I am referring to the Puranic shloka, I also have to refer to the timeline and the context where the shloka was come, and by referring to the taxes. When Yudhishthira was getting his kingdom, he was made up as a king. That time he wanted to understand the politics, he wanted to understand economics, he wanted to understand taxing system, administration, etc. So at that point in time, he went to the Pitamaha, the Bhishma, to understand all these things, right? So that time Bhishma had given this shloka, that you can collect taxes at the ratio of 1/6 of their income, and if you need more revenue for your government, you cannot increase your taxes. That is what the maximum tax you can able to levy. If you want to get more revenue, then catch hold of all the accused, okay, whoever is making mistakes, Shastra Nitena, whoever is going against the law, catch them, levy fines to them, penalties to them, and that will give you a revenue for running your government. So that is what the suggestion given by the Bhishma at that point in time. So this is from the Mahabharata. Now coming to the history of taxation in India again, after Arthashastra and all, after the Christ was born, then we are dividing our history into 3 stages: ancient India, medieval India, and modern India. So starting from the ancient India, we had various types of taxes starting from the Gupta era, Guptas, when it was the Gupta Empire. So there were so many taxes: Kalpita or Upkalpita, which was called as sales tax, Halivakar, taxes on cultivations, Prataya, toll tax, Bhog is the share which the people will share with the king. Whatever the producers they make, they will have to share a portion to the king. That is what the rule prevailing at that point in time. It was not only for the cultivation, it was also for the trade. Whenever a trader comes to a new kingdom, okay, the trader has to give a portion of share. They have to offer, out of courtesy, offer it to the king in the beginning, and then the king will allow, by having become happy of receiving some share, the king will allow the trader to make trading. And we all also know that the name Customs Act, okay, the Customs Act was also drawing from the same reference, because at that point in time customarily people were following this Bhog, where they were sharing money to sharing some of their produce to the king. That customary practices were later imposed or levied on the people. Okay, that customary practices being followed in the form of a legislation. Okay, we are calling it as a Customs Act. That is the name the Customs Act had drawn from. And Bhatta was the police tax. Right, and I have referred in the earlier slide that the name Bali referred to the tax. So this Bali, it is not a new word. I remember, I understand that it is not a new word. Even in Tamil also we use the word Bali, right? When we do some form of function, temple functions, religious functions, etc. We give Bali. We just cut some goat or hen or something. So that is something like offering the money or offering something to the god. The god is our king almighty, so that is how the word Bali is being dragged there as well. So this is what when the Gupta era was there. Then when it comes to the medieval India, medieval times, that time there was Sultanate period. Sultans were ruling us, and that point in time Kharaj was available, which is called as the land revenue. And land revenue, actually it was in the beginning by the sultans, it was levied as 1/5 of their income from the land as to be paid as tax. And when later sultans, who was very famous, Alauddin Khilji and Muhammad Tughlaq, had made up to the level of 1, that is 1/2, 1/2, that is half of your income you have to pay it as taxes. So that is what the sultan had made. And this may not be new, jizya. Anyone know here jizya, right? Anyone here heard about jizya? Because I have heard jizya. Jizya was again imposed by those Islamic rulers on non-Islamic people. Okay, over and above the regular taxes which everyone has to pay, there will be an additional taxes which a non-Islamic followers has to pay at that point in time. So that was one of the taxes that time, or even today we refer it as a gruesome model, right? Because it is not following an equality. So that is what jizya taxes was. Octroi duty, as I was referring to, and zakat. Zakat is a normal taxes, nominal taxes which was levied on Muslims by those Sultanate period. Gari tax, people who were having houses has to pay a tax for having houses, that is Gari tax. And Chari tax, if the people are owning animals, horses, cattle, whatever the animals, and they earn income out of the animals, they have to pay a tax called as Chari tax. And when it comes to the Mughal period after Sultanates, Todarmal Bandobast, that was the word referred that point in time. This particular levy was made at that point in time as if any people who were not having good cultivation this year, for example, because we are all paying income on the current year income, right? So whatever the income we earn in the previous year, we pay our taxes in the assessment year. And if you don't have an income, if you incur a loss in the previous year, obviously you are not asked to pay taxes. That is what the current system is. But that point in time, Mughal system, they were following, if you don't have a profit in your current period, don't worry, you can take an average of the last 10 years and you make a calculation out of it and pay tax out of it, so that it is sealed. The taxes were sealed, the income for the government was sealed by this type of levy, this type of system which was followed. And there were other forms of tax which is called as the Batai. Batai taxes were in 3 forms at that point in time. So one, we call it as Baoli. Baoli is something where after the harvesting is over, the crops will be accumulated and placed in a separate place. Government will step in, they will bifurcate those crops, and one portion will be taken by the government, other portion will be taken by the cultivator. That is how that Baoli was practiced. Second form was Khet Batai. So that Khet Batai was nothing but I will not wait until the cultivation. I won't segregate the cultivation. I will segregate your land portion. Okay, why to wait until the cultivation and then segregate it taking my portion? I will divide the land in which my share is there. If any crops, cultivations come from it, that is my share, that is the government share, and the other portion will be for the cultivator. That is how the taxes were segregated. Then Lang Batai. So this Lang Batai is something, a refined version of the Baoli. What is that refined version? Baoli crops will be segregated. In the Lang Batai, the yield from the crops, that is the grains which is extracted from the crops will be segregated, and one portion will be taken by the government, other portion for the cultivator. This is during the Mughal era. And later came Marathas. So in the Marathas empire, we were having something called as Chauth. Whenever they invade to a new kingdom, from there they will levy a tax which is 1/4 of the revenue of that particular kingdom. It has to be contributed for the military, the soldiers which have invaded that particular kingdom. Okay, for their well-being, the amount has to be contributed. Then Sardesh Mukhi, this is something for the central government, right? There will be one central government, and the people under them will be going to kingdom by kingdom for invading and taking it. So for their welfare, the first type of tax was levied, 1/4 of the share, and over and above that 10% additional tax was levied, which is for the contribution to the center. That is how the system was followed in case of Marathas. Then came the British rule. Under British rule, we all know that there were 3 systems followed. One is the Zamindari system. 3 systems were followed and implemented on different timelines. First was Zamindari system implemented in 1793, where the land will be apportioned, allocated to certain people who will be called as Zamindars. And those people are entrusted with the work of collecting taxes for those areas. They will collect taxes, some portion of share will be retained by them, the balance portion will be paid to the British Raj. That is how the system was under Zamindari system. Then Ryotwari system. So under this system, which was developed by Thomas Munro in the year 1820, that Ryotwari system was predominantly implemented in the southern part of India, right? And which is similar to Zamindari. And later Mahalwari system was implemented by Holt Mackenzie, introduced in the year 1822. It was implemented for the central province, northwest provinces, including Agra and Punjab. So these are all the systems of collecting taxes by the British rulers. Now we are just seeing some of the revolutions, tax revolutions happened across the globe. Tax reforms in England, which was happening in the year 16th to 17th century. The Tudor and Stuart monarchs intensified the taxation through enactment of various laws in 1689 and 1688. Later, American Revolution happened. So American Revolution happened in the year 1776. The colonists who were protesting against the British rulers of America at that point in time, they were actually proposing and were implementing such laws like Stamp Act, Tea Act, and they were having a famous slogan, no taxation without any representation. So the US Constitution empowered Congress to establish federal acts. Actually, when they were making a revolution against the Britishers, by the Americans at that point in time, they were actually they wanted to follow a system where American representatives has to be there in the British Raj or British government. If there is a representation by the American people, then only the taxes will be paid. That is what the systems they were proposing at that point in time. And the French Revolution happened in 1789. And because of the heavy outrage of the people during the French Revolution, they have made a lot of taxes implemented at that point in time. So around the globe, the taxation laws initially enacted. Okay, the current system of taxation law, I am not speaking about the ancient history, how I talked about for India, but I am talking about the current system of taxation which is followed by various countries, at least the developed countries. In USA 1913, the federal tax laws was initially implemented. In UK it was 1842, and Germany 1893, and in Australia it was 1915. So these were all the years when those countries were having their enactments of formal taxation system. From the globe, we are now entering into the history of Income Tax Act in India. So coming to the India, in 1857, there were bigger soldiers' mutiny happened against the British rulers. The British ruler were sustaining big losses at that point in time. So they wanted to compensate those losses. The losses were compensated by making a proposal of levying taxes, okay, directly on the income. Before the taxes were also there, but income tax, the word income tax exactly on the direct levy, were proposed by the first finance minister of India under the British rule, British government, who was James Wilson. He had proposed income tax. It was not actually a formal enactment in 1860. They were having rules, they were having some orders for which income tax will be levied on the people, but the formal act came later. So this 1860, we can say it is the tracing of the current tax system back in the British period. Then the first act, as I was mentioning, the act was actually not having a separate act. It was actually a mix of various laws, and the income tax portion was having some 259 sections at that point in time, and the income was divided under 4 different heads. Income from landed property, income from the professions and trade, income from securities, annuities and dividends, and income from salaries and pensions. So this is what 4 heads under which the income was proposed to be taxed by the British in the first time, when the first concept when they were bringing in, right? This is, I know, and by now we have understood that this is not the income tax is not new to India, but new from the British side or British text, and the majority of the text which we are currently reading is actually taken from these texts. Tax rate at that time, it was proposed at the rate of 2% on the income above 200 rupees up to 499 rupees, and beyond 499 rupees it was 4%. So slab rate was available, and that 4% actually 1% will be retained by the state and 3% would be shared to the center. So that is how the system was made. First financial year commenced on 1st of August 1860 after this tax was proposed. Other levies were also there, which is customs tax and salt tax. Salt tax later abolished, we all know about that history, which Mahatma Gandhi had contributed through Dandi March, and the salt tax was abolished later. And the municipal taxes for the local authorities administration for their collections, municipal taxes was introduced by Lord Ripon. So that is how the Ripon building is currently there. And later in 1886, separate income tax act was enacted. As I was mentioning, like how we were having service tax, service tax was not having a separate act. We were following Finance Act 1994 when it comes to the service tax law. That is how the income tax was initially introduced. Later on, they have brought a separate act for Income Tax Act in 1886, and those time the heads of income was slightly rearranged in the manner that salaries, pensions and gratuities were having one head, net profits of companies, interest on securities of the government of India, and other sources of income. So these 4 heads were available in 1886 Act. This 1886 Act was repealed with a new enactment. This 1918, what is the period 1918? Anyone know? Very good. First World War, it had come to end, that First World War. After that First World War got over, India also were suffering from big losses. So the government were not having a big money. So the tax system which they were following was not actually sufficient for them to come back. That's why they wanted to increase the tax coverage, as well as they wanted to increase the rates of taxes. That's how 1918 law was implemented. So to have more revenue to the exchequer. Within 4 years, in 1918. That act was again abolished in 1922, and a new act was passed. Under 1922, this act, we can say it is like a landmark act, 1922 act. The present department, income tax department system, follows this 1922 act. Various roles of income tax department, like principal commissioner, commissioner, assistant commissioner, inspector, all these roles of income tax officers were defined in this 1922 act, and that is what the act being followed even today, with small modifications, obviously later date. And this 1922 act had faced innumerable amendments, right? World War II later happened, so for that also they wanted to again go back to collecting revenue, so they wanted to again introduce lot of amendments to the existing act of 1922. So this 1922 act had crossed the independence as well. Okay, it was there even after independence. In 1956, post independence, the government wanted to change the law. They wanted to bring a new set of act. So what they wanted is, they proposed to constitute a committee, okay, under the Ministry of Law. That committee will draft a new income tax law by removing or replacing the earlier law, 1922 law. After the consultation, Ministry of Law has brought this new Income Tax Act 1961. So the present act which we are currently referring to was brought in the year 1961 by the Ministry of Law, after making the detailed drafting for almost 4 to 5 years. This 1961 act was first implemented. The effective date was fixed as 1st of April. We all know 1962, right? So that act, even today we claim that it has only 298 sections and 23 chapters and 14 schedules. Because when I was actually studying, when I was doing my CA intermediate and all, when this income tax act was first introduced to me, that time I saw this 298 sections and I saw, okay, maybe it is not so big. People were actually scaring me. Only 298, right? So then I saw that the main sections were 298 and it was going subsections and to 1A, B, C, something like that, it will go on. And till now I have not counted. Anyone here knows? I think I welcome anyone here knows exactly how many sections, not subsections, the main sections, how many are there? Anyone knows here? Even I have not counted that, how many sections we are having currently in 1961 Act. And we all know the present system of classifying the income under 5 different heads, and this is what even proposed in the 1961 Act. So that is what I had when it comes to the evolution of income tax law. So by end of this session, or by now, we all have understood that obviously this is not a income tax 2.0. Is it an income tax 2.0? Even because the act itself was replaced many times, starting from 1860, 1886, 1912, right? So then 1922, then 1961. Now we are proposing for the new bill. I think Sir is there to give more lights on the new bill. And in this new bill, what is our, I just wanted to have a small discussion here. What is our takeaway on the understanding, basic understanding of this new bill? Just a small inference. Is it a new law, new system of income tax? Yeah, actually what I feel, the government doesn't like the alphabets along with the numbers, right? So 115O, 115Q, why I want that alphabets? Let me again bring back to the numbers. So that is what they have made, in my personal opinion. And secondly, as Sir was rightly mentioning, they wanted to do some cleaning process. It was 1961. We are almost speaking about 70, 60 plus years. 60 plus years, if you weed, what will happen? It will all become so dusty, right? We are just making some cleaning. So that cleanup process had happened by proposing this new bill. And we as professionals and members, in fact I am maybe younger among many, and many have missed to the joy of reading, right? The missed to the joy of reading new things. So the government want us to read new things. Again, go back and read. Why are you just sitting at office, saying that you were providing some consultancy services, tax services, etc. Again, go back, read and come back. So that is what the government intended. So they wanted to replace the sections. How they have done for this IPC replaced with BNS and all, right? So that is what maybe the basic takeaway on this new provision. Obviously the government wanted to make this more complicated, because already the A, B, C and all had gone. Maybe up to Z it is gone in some sections. They don't want to go with ZA, ZB, ZC and all. So then if they start again from 1, 2, 3, then comfortably they can add A, B, C and all later. So anyone here assume that the law is being simplified, the income tax law is being simplified, right, because of the new bill which is proposed. Anyone here think that way? It is going to get simplified. And some of my colleagues or some of my known friends who are also chartered accountants practicing, they were starting to let out their scare. They started becoming scared. They were thinking that, actually I was thinking that I wanted to practice in direct tax, but since this law is becoming simpler, everyone will know the law themselves. Income tax law, if you call a 12th standard guy and ask them, income tax law, what is this? They will know, right? So we will not be having any job in income tax. So our future in income tax is over. It is all sunset, done. We have to look for other alternative areas to practice. Is that so? Anyone think here is that so? Because the simplest system of taxation which the government proposed recently, that is some years back, what was that? And we all know what is the present system, present condition of the GST law. And it was like something, when it was introduced, I remember it was something like how Steve Jobs used to unveil every version of iPhone. Okay, a big revolution happened. A revolution, something like that. So now you are going to do everything at ease. This phone is going to make your life so easier. And we also thought that these smartphones are going to make our lives easier. Is it easier with these smartphones? It has become more complicated. That is how the society acts among ourselves. That is how GST law also we have witnessed. And the Income Tax Act also is going to witness. I think some of the things which Sir wanted to bring, I think I have brought it here. So that is what I had all about today for today's session. So maybe there is nothing much I can able to ask Sir if there are any questions. That is what I have been practiced with. Every session I complete with my students when I take classes. At the end I will have this one dialogue. Any questions you have? Now I don't know whether any questions you will have on this particular session which I have taken.
We only wish that the new act is drafted properly in a simple manner, and it will not undergo changes like Companies Act 2013. As it's 1956, 1956 Act underwent only one of or otherwise. 2013 Act has undergone changes in the last 10 years, so many times as number of years. So in that context, we only wish that the drafting has been made simple, understandable, not complex, and not confusing.
That is nice. Actually, here I just wanted to add one thing. Government is also proposing the same thing. They wanted to actually replace with the complex words with simpler words. That is what they tried with GST law also, right? The narrative of law has to be in simpler English, simpler words. That is how the law is also, they think that it will become simple. But by having simpler words, now it had multifolded the interpretations which we can make now with the words which is becoming simpler, right? And if the government, I have already gone through little bit of the new bill which has been proposed as well. If the government intended to make the wording simpler, we can start and roll up our sleeves and get ready for a good practice for income tax in the future. So that is what we can able to think about. Yes sir, anything? Okay, thank you so much for the opportunity. I would like to thank SIRC for giving me this opportunity to address this August session in front of members. In the beginning I was actually a little scared, since I was already told you that this is my first CP here. So I was having pretty much of scare. So I have tried to deliver whatever I was able to. If something is not clear, please pardon me. Thank you for your attention and time.
Thank you, sir. Thank you for your valuable effort and into delivering such a valuable presentation, sir. When we first approached you, we have to take the history of the income tax, sir, you didn't hesitate at all, and you said you will take the sessions, and it was a wonderful session, sir. And I once again thank you, sir, on behalf of SARC for this one, providing this valuable insight on this income tax act. Okay, okay, sir. We will be next providing with an overview of Income Tax Act 1961 and with a new income tax bill by Naveen Wadhwa, sir. But due to some commitments, he will be taking in the session online. So we will be proceeding. The second session will be online.
Hello.
Hi, sir. Yeah, so before we start the session, I would like to have a small intro of Naveen Wadhwa, sir. Naveen Wadhwa, sir, is a research and advisory. He's a vice president of research and advisory of Taxman. He is also a distinguished chartered accountant who secured All India 24th rank. He brings over 15 years of expertise in income tax and international tax, along with 12 plus years of experience in product development. He has a vast experience across diverse industries ranging from real estate and technology to hospitality and manufacturing. Naveen CA has been an instrumental in simplifying complex tax and driving innovative digital solutions. He is also an author, speaker, and thought leader who impacted the field of taxation and corporate tax law using platform as Taxman platform. So we are honored to have him with us today. So, sir, over to you. We'll start the session online.
All right. Thanks a lot. So I need just one quick confirmation if my voice is clear.
Yes, sir, clear.
All right. So very good morning, everyone. Wishing everyone a very happy Holi. And so I start with my introduction. I am CA Naveen Wadhwa. I qualified in November 2007, and right now I'm working with the Income Tax as Vice President, and I am leading the Research and Advisory Division and the Digital Content Division of Taxman. So it's my pleasure to speak before my colleagues, my peers, my seniors on Income Tax Act versus Income Tax Bill. So before I really start with the technical discussion on the changes in the Income Tax Act vis-a-vis Income Tax Bill, so I should start with sharing my experience of being Gen Y. And the speaker who was speaking before me, he was talking about iPhone, the revolution. So I also want to start my presentation with on the same note. So as a Gen Y, we have seen evolution, we have seen development both in technology as well as in the basic framework of law, which deals with our day-to-day businesses. So let's start with the technology. So we have seen those bulky CRT televisions to now very ultra thin television which respond to our voice commands. We started working with the landline and the pages. Now we have smartphones with extraordinary 5G speed. So that's the development we have seen in the technology. Now coming to the business laws. So we have seen excise, service tax and VAT being transformed into GST. We have seen Companies Act 1956 turning into Companies Act 2013. Then we saw accounting standard to now we have both Indian accounting standard and the accounting standards. Then we got CRPC, IPC, and Indian Evidence Act. Got the new successor the last year in 2023 in the form of Bharatiya Nyaya Sahita, Bharatiya Nagrik Suraksha Sahita, and Bharatiya Sakshya Adhiniyam. And now the finally we have Income Tax Bill or Income Tax Act 2020-25, which would replace the Income Tax Act 1961. So with that background, I start my presentation. So I'll be speaking for next 2 hours. As per the agenda, I have to take a 50 minutes break at 11:30. We'll resume the discussion at 11:45, and in next almost 90 minutes to 100 minutes, I'll be speaking on the key changes in the Income Tax Bill versus Income Tax Act. At the same time, I'll also be highlighting the overall structure of the income tax bill. And the last 15-20 minutes I'll keep for the Q&A session. So before I start, I just share my screen. And all right. Yes. So one confirmation if my screen is visible. 90. Except the NPO, I have covered all other provisions of the income tax bill. So I'll start with the introduction. So the foundation for introducing this income tax bill was laid down in the budget, the Finance Number 2 Act 2020-24, when the Nirmala Sitharaman she announced to come up with a new income tax bill, and it would be a comprehensive review of the existing Income Tax Act. And the objective was to make it very concise, clear, and easier to read and understand. But still, I believe that objective could not be met after reading the new income tax bill. And the difficulties, that interpretation problem will still arise. And I believe the new income tax bill basically it's a new pistol with the old bullets, right? So it's still the same, except by removing the provisos and explanation, except by slightly tweaking the language of the provision. The essence, the soul is still remain the same. So I believe the litigation can not be avoided even after this income tax bill is enforced. So the income tax bill was tabled in Parliament on the 13th February 2025. And the status as on date is it has been given to the Standing Committee for their comments. And as per the instruction given by the Finance Minister, the Standing Committee will present its report before the next session. So next session would be the monsoon session. So possibly in the month of June or July, the Standing Committee will present its report on the income tax bill. So until that bill is presented, until we get the confirmation, the green signal from the Law Ministry, I would say just take this income tax bill with a pinch of salt, because still there are a lot of gaps in the income tax bill which I believe should be fixed before it becomes an act. In terms of the overview, you all know about now, it's been a while since this income tax bill has been presented. So it's this 600-page income tax bill will replace the 65-year-old Income Tax Act and possibly will become the Income Tax Act of 2020-25. As per the bill, this act will come into force from 1st April 2026. So it means all your income you earn till 31st March 2026 shall be governed by the Income Tax Act 1961. Overview of the bill. The income tax bill contains just 2.56 lakhs words, which is almost 50% less than the 500,000 words in the Income Tax Act. And when you read the income tax bill, you will see that what they have done, they have tried to make it things little simple by using lesser words, but the intent is still remain the same. So, despite the reduction in the legislation size, the essence of the ITA has been retained, and this was logical because the Income Tax Act has been, as we saw it today, it has been amended by more than 80 Finance Act and Amendment Acts. More than 4,000 amendments have been made in the Income Tax Act. And if you talk about just the charitable trust, it has been amended more than 20 times in the last 60 years. So it is logical to not change the income tax bill in entirely, retain the essence, retain the soul of it, so that it does not unsettle the things which got settled in last 60 years. And specifically, you cannot experiment with a legislation which is giving you 25 lakh crore rupees of revenue. So this is the reason that the government has tried to retain the essence and not tinker with the language much, so that it gives lot of scope of litigation or interpretational issues. The 911 sections, which include the omitted sections, almost 300 sections of the current 911 section have been omitted in the income tax bill, and the 11 schedules of income tax act, they have now been restructured into 536 sections and 16 schedules. Some of these schedules also cover various provisions which currently are part of these sections, like section 10, section 17, section 9A. Some of these sections are now being included in the schedules of the income tax bill. The income tax bill eliminates 300 provisions of the Income Tax Act which have either been become redundant or were omitted over the time. I believe by the time it becomes an act, still almost 50 more provisions can be easily be removed from the income tax bill, and these provisions basically pertain to the old tax regime. So after this recent budget, the finance bill, wherein they have increased the limitation, they have increased the slab rate, and they have increased the 87A rebate. The new tax regime is by default, I would say, is the most lucrative and beneficial regime for almost all the taxpayers, except for those who are making lot of donations, or who are claiming 80 QQB or 80 RRB, or making political donations. Except just few of them, I believe the new tax regime is more beneficial for almost everyone. If that is the scenario, then the old tax regime virtually is of no use in the Income Tax Act. If the government decides to remove all the provisions relating to the old tax regime, which I believe there is a possibility, in that situation, then 50 more sections can be reduced. In that situation, the income tax bill will be more thinner, so it will lose a lot of calories, which I am not able to do it in spite of doing a lot of efforts. So now coming to the next point. So 1200 provisos and 550 explanation of the Income Tax Act is have been completely removed from the income tax bill. You won't find even a single proviso and an explanation. All of these provisions have been covered in the form of a subsection, clauses or sub clauses in the income tax bill. The income tax bill does not contain even a single proviso or an explanation. Now, in next two slides, I'll be just giving you a quick overview of the income tax bill, the number of sections, which sections pertain to which provision. So the legacy of the ITA has been retained in the ITB to prevent unsettling the Income Tax Act, which has gained little certainty, and after more than thousands of amendments through 80 plus finance acts and the amendment acts. As I mentioned, the charitable trust provisions have been amended by more than 20 finance acts since 1961. I believe TDS and the charitable trust are the two most uh, litigative or disputed regime of the Income Tax Act, which couldn't be settled. And every year, in every budget, you will see some amendment in the provision relating to the charitable trust and the TDS. In income tax bill, that's why they have made substantial changes in these two areas. Now coming to the scope of the work and the charge of the income tax, the section number is still the same. Section 2 of the income tax bill contains definition, and I'm just taking a pause. So wherever I'm referring to section or clause, though when it is a bill, we do not call it a section, we always call it clause. But for discussion purposes, I may be using the section, but you can take it as a clause. So definitions are in clause 2, clause 4 and 5. They pertain to charge of income tax act, charge of income tax and the scope of tax total income. So I believe in the entire income tax act, the most simplest thing is the sequence of the provision. So you start with 1 and go to 536. That is the only simplest thing in the income tax bill. Otherwise, the complexity still remain, and there are no alphabet, no alphanumeric section number. Everything as of now is in numbers. But I believe after this becomes an act, and after immediately after the next budget, we will see, just like income tax act, some the alphanumeric section numbers. Section 6 deals with the residential status, and section 9 is with the income deemed to accrue or rise in India. The charging provisions for salary, house property, business profession, capital gains, and other sources are in clause 15, 20, 26, 67, and 92, respectively. The clause 96 to 100, they address the clubbing provision, while 108 to 121, they deal with the set off and carry forward of the losses. The deductions are in 122 and 154. If, as I mentioned, if the old tax regime is removed in entirely, so many sections from 120 to 154 can be removed. The transfer pricing regulations are codified in clauses 160 to 177. The special tax rates, which is basically 111A, 112, 112A, they are in 190 to 198, and the new tax regimes are introduced in clause 199 to 205. The taxability of the non-resident and the foreign companies is covered in clause 207 to 220. The income tax returns and assessments are in section 263 to 286, and the provision relating to the block assessment, which were reintroduced last year in clause 292 and 301. As I mentioned, the provision relating to the non-profit organization or the charitable trust, it has been changed in entirely. Now we have a new chapter called Chapter 17B, covers clauses 332 to 355. So it covers everything relating to the taxation of NPO in one chapter. The appeal mechanism are outlined in the clauses 356 to 374. One of the key changes they have introduced is in the provision relating to the TDS and TCS. So as of now, we have got more than 65 sections dealing with TDS and TCS. And in comparison to that, in income tax bill, we have just 9 clauses dealing with 390 to 398. So what they have done, they have followed the uniform approach while drafting this provision, be it like crediting the sum to the suspense account, the time of deduction, except the rate. I would say except the rate and the nature of the pay, they have tried to retain the same structure so that they have put the entire the TDS rate, the pay, the time of deduction, everything in the form of a table. So that's why they could club everything which was earlier in 65 provisions now in just 9 sections. The penalties and prosecutions are covered in clauses 439 to 498. The ITB has 16 schedules, which is in comparison to 11 schedules in the Income Tax Act. Some of these schedules were previously covered under the sections of the Income Tax Act. Just giving a few examples. So like we have section 9A, which deals with the eligible investment funds, and the fund manager is now being part of some of the provision of section 9A are considered, are added, included in section 9, and some of them are added in one of the schedules. Then 6 schedules, they provide a list of the incomes exempt from tax, which is corresponding to section 10 of the Income Tax Act. One schedule specifies condition for exemptions to the political parties and electoral trust, which is basically currently part of section 13A and 13B. 5 schedules pertain to PGBP, including 2 schedules address the agricultural boards. 1 schedule explain the deduction allowed under section 1 under clause 123, which is corresponding to section 80C. So all those eligible investment which you can make to claim the 80C deduction has now been included in the schedule. 1 schedule outline the rules related to the recognized provident fund and approved superannuation funds or the gratuity funds. And the last schedule, it defines the modes of investment for the charitable or the religious trust, which is currently being part of section 11.5 of the Income Tax Act. So now coming to to the provisos and explanation. So everyone is talking about there is not a single proviso and the explanation in the income tax bill. They have removed it, but they have added is as a part of the main provision, either in the form of subsection or the clauses or the sub clauses. So I was little curious while reading the income tax bill. Is it a practice to whenever you come up with a new bill, you do not have any proviso or explanation? So to really check if my understanding is correct or not, so I checked IBC, I checked Bharatiya Nyaya Sanhita bill, Bharatiya Nagrik Suraksha Sanhita, and lot of other bills to see if whenever a new bill is introduced, is it a practice to not have any proviso explanation? The answer is no. In every bill, I couldn't find even a single bill which did not have a proviso or explanation. So proviso and explanation, they may have their different purposes of adding them to a particular section. So why it is so? So I'm not going to give you an understanding of how it is going to impact any particular section or any particular provision if there is no proviso explanation, which was earlier there in the income tax bill. But I am giving you some understanding of how the courts have defined whenever you read a statute, how do you read a subsection, how do you read a proviso, and how do you read an explanation. So I am just highlighting some of the landmark rulings wherein they have defined the meaning of these terms. So a statute is arranged in sections and subsections, which are grouped into distinct chapters and subchapters. As you can see that in Income Tax Act, it has got multiple chapters and subchapters as well as section and subsections. So when a section or subsection needs a qualification, clarification, explanation, or detailed annexure or list, it is done with the aid of a proviso, an explanation, or a schedule. So when you read a subsection, all the subsections forming part of a subsection of a section should be read as a whole. So this Bombay High Court in the case of CIT versus Victoria Mills Limited has said this. While at the same time, so we have another judgment by the Calcutta High Court which says where two subsection of a statute provide for a different matter, there is no need or necessity for reading the subsections together. When it comes to the proviso, we have a Supreme Court judgment. The Supreme Court said a proviso must be considered with relation to the principal matter to which it stands as a proviso. Sometimes a proviso can be read as an independent provision. So you can see that, so we have got variety of judgments on how you read a subsection, how do you read a proviso, as well as how do you read an explanation. An explanation to a section is not a substantive provision by itself. The intention of adding the explanation is that if anything is not clear in the main section, then it shall be made clear by adding the explanation. As you can see in section 9, section 90, section 195, we saw multiple explanations and proviso after that Vodafone ruling, and all these proviso explanation amendments were made retrospectively by the Finance Act 2012. An explanation may be introduced by way of an abundant caution to clear any doubt surrounding the meaning of a statutory provision and to place what legislature considers to be true meaning beyond any controversy and doubt. So as I mentioned earlier, as of now, we may not have any proviso and explanation, but we should take this income tax bill with a pinch of salt, possibly after the standing committee comes up with the report and after the law ministry reviews the entire income tax bill, they may suggest to introduce some proviso and explanation, or if that does not happen, by the time it becomes an act. But I am pretty sure in next couple of 2-3 budgets, some proviso and explanation will definitely reincarnate and will be added to the Income Tax Act. The explanation does not enlarge or limit the provision unless the explanation purports to be a definition or a deeming clause. So as we know, explanation cannot work independently. Either it contains a definition or it is a deeming clause in almost all cases. So when a statute has been made applicable with effect from a particular date, it could be construed prospectively and not retrospectively. But this principle will not apply in case where the provision construed is merely explanatory, clarificatory, or declaratory, and the explanation is to explain the meaning and intendment of the act itself. And the best example which I just mentioned is amendment in section 9, wherein they have added lot of explanation by the Finance Act 2012. So now, as you can see, this by removing this provision explanation, they have made the reading simple, but I believe that may give some dispute to the interpretations. It may increase the litigation more. So we have to see each provision on a case-to-case basis before we really come up with a solution with an answer. If by removing the provision explanation, the Income Tax Act has become more easier, it has become more complex. So as I was told earlier, at 11:30 I have to take a break. So I'm just taking a break, and at 11:45 we'll start with the notwithstanding and the irrespective of discussions. So with that, I need a confirmation if should I end this presentation for pose this presentation for next 15 minutes.
Okay.
All right. All right. Welcome back. Again, one confirmation if my screen is visible. Can you see the PPT?
Yes, sir. Yes. Yes.
So now coming to the next point, in this entire income tax bill, not in even in a single provision, you will find the word notwithstanding. It is not clear why they have stopped using proviso explanation and the word notwithstanding. And in place of notwithstanding, everywhere the word used is irrespective of. Though in if we go by the English meaning, so you may not find much difference between the two words, that is the irrespective of and the word notwithstanding. But when we when we go deeper, you will find a lot of difference between these two words. So I could find out one judgment, two judgments dealing with these two terms. So the notwithstanding is basically a non-obstante clause that is usually employed to give overriding effect to certain provisions over some contrary provisions. The non-obstante clause may be invoked only in case of irreconcilable conflict. So in simple words, so if we have two provisions A and B, as long as there is no conflict, both the provisions can be applied independently. But in case of a conflict, then the provision A, which start with a non-obstante clause, will have an overriding effect over section B. But that is not the scenario if the term uses irrespective of. So the meaning, the English meaning of irrespective of is without taking account of and regardless of. So this term is much broader than the expression notwithstanding. So we have one judgment by the Supreme Court wherein they have dealt with both the terms. The court mentioned that the irrespective of may require disregarding any other provision, whether or not there is a conflict. So I repeat it again. Irrespective of may require disregarding any other provision, whether or not there is a conflict. In contrast, the expression notwithstanding implies that the provision will have an overriding effect in case of a conflict. So when we go by the definition, you may not be able to appreciate what impact is gonna have on the interpretation. But when you read any particular section in comparison to the corresponding section of the Income Tax Act, you will find a lot of differences. Just starting with few examples. The income tax bill uses irrespective of wherever it wants to disregard all other provisions and contrary to provision where it wants to disregard the conflicting provision. In the Income Tax Act, we were seeing the expression notwithstanding to deal with both the situation. So now we have not irrespective of and contrary to provision vis-a-vis notwithstanding in the Income Tax Act. So giving you an example, which is clause 58, which deals with the presumptive tax scheme. It starts with the provision of section 26 to 54. To the extent contrary to this section shall not apply. Clause 194 specifies the tax rate for special income. It starts with irrespective of anything contained in any other provision of this act. In contrast, Income Tax Act gives the overriding effect by using the term notwithstanding in both corresponding provisions. So in context, if we want to have a discussion on this point, so giving you an example, so we all know about section 50, which provides that the capital gain arising from the depreciable asset shall be deemed as the short-term capital gains. And this provision has been dealt with by multiple courts and the tribunals, and they mention that when that deeming fiction of section 50 should be limited to section 50 only. So even let's say you have transferred a depreciable asset, still you can claim an exemption under section 54 or 54F or 54 EC, because uh, because of these words notwithstanding, and because of the deeming fiction limited to section 50, they you can still apply all other provisions, but the situation may change in entirely. If we talk about the income tax bill, if it uses the term irrespective of, that means all other provisions shall be disregarded completely, even if there is no conflict between the two provisions. So that is the impact of notwithstanding and irrespective of. So while reading any particular section yourself, then just keep these two terms in your mind and then do the interpretation of the new provisions of the income tax bill. So before I start with the comparison of the ITB versus ITA, I I am picking up the last section, which is 536, which is a repeal and the saving clause of the income tax bill. So it contains three subclauses. Subclause 1 repeals the Income Tax Act 1961. Subclause 2, it prevents a legal vacuum that is created during the transitional period. When we jump from Income Tax Act 1961 to Income Tax Act 2020-25, it preserves certain rights, obligation, or illegal effects arising from the repeal law to prevent any kind of disruption. Subclause 3 applies Section 6 of the General Clause Act 1897 with regard to effect of the repeal. The most interesting clause in section 536 is subclause 2. Basically, it deals with the tax credit, carry forward losses, unobserved depreciation, everything which for which we have a provision in the Income Tax Act. And let's say you do not comply with certain conditions, and the impact of which is carried forward to the subsequent year. So this subclause provides that all those implications, all the consequences shall be dealt with as accordance with the Income Tax Act 2020-25. All provisions almost same. It is not going to have much impact on you, except the item number N of subclause 2 of clause 536. It basically deals with the how do you treat the capital loss computed under the Income Tax Act, and how do you treat the same under the Income Tax Bill 2025. So it completely removes the demarcation of the capital loss into the short term and the long term only when your capital loss were computed under the Income Tax Act 1961, but now you are carrying it forward and claiming it as a set off in the income tax bill. So if you do that, all your losses computed under the Income Tax Act 1961, you can adjust, set it off without considering whether it's a short term or a long term. So in simple term, your long term capital loss can be set off against the short term capital gain and vice versa. But this treatment is allowed only for the transitional period. It means all your losses which were computed under the Income Tax Act can be set off without considering the nature of the losses under the income tax bill. But any capital loss which you have incurred and computed under the income tax bill means on or after 1st April 2026 will be set off as per the existing provision we have in Income Tax Act in section 1771. Right. So this is the only provision which in section 536, which I believe is good enough to highlight in the repeals and saving clause. All other provisions are pretty logical and senseful. So there is nothing which I should highlight in section 536. Now coming to section 2. Section 2 of the income tax bill, it contains all the important meanings. Just like section 2 of the Income Tax Act, it covers all the important definition, but it has expanded the list a bit, where it covers all other definitions which are used at multiple places. Now they have been defined in section 2 rather than in the respective sections. But there is still one problem, which is there are a lot of sections, a lot of meanings which are defined in the schedules, which they could have defined in section 2, but they have defined in the schedule for some purposes. Section 2 of the income tax bill, it covers 112 subclauses, which covers all the important definition. The another important change in the income tax bill is they have completely removed the word previous year and the assessment year. Now these two terms are rest in peace, and we have in place of it is tax year. So whenever they want to mention previous year, they are using the word tax year, and in place of assessment day, they are using 12-month period of the financial year. A tax year is defined as 12-month period of the financial year commencing on the first day of the April. For the assessment year, they are using subsequent to the tax year. So I believe this is much needed, and it will end lot of confusion. And every year we see lot of confusion in terms of the applicability of any particular amendment. We always struggle to find out it's applicable from a previous year or from the assessment year. And many readers, in fact, many tax professionals, they find it difficult to understand these two terms when it comes to the amendment and certain other things. And sometimes these two terms sometimes becomes a blind spot for you. You may read previous year assessment year and vice versa. So I believe by using the word tax year, they have ended this confusion, and this is much needed. Coming to the residential status, the provision is almost the same as we have in Income Tax Act, except in one of the provision they have used for employment outside India instead of for the purpose of employment outside India. So to giving you a background of the provision. So as you know, to determine the registered status of an individual, so we have to comply with two conditions: stay for 60 days or more in the current year, and 65 days or more in the last 4 years. But in case of an Indian citizen who is traveling outside India for the purpose of employment, this 60 days condition does not apply to him, and he has to be in India for 182 days in India. For and the objective of his traveling outside India is for the purpose of employment outside India. Now, instead of it, the income tax bill for employment outside India, which I believe is more rigid term vis-a-vis the existing term, which was more broader and wider in space, wider in scope. But in comparison to that, the income tax bill uses the term for employment outside India. So let's first understand the meaning of for the purpose of employment outside India. So we have got one advanced ruling and one tribunal ruling, one high court ruling, wherein they have defined the meaning of for the purpose of employment outside India. The judiciary held that it defines that the purpose is not necessarily should be the main. If there is a proximate reason for him traveling outside India, and that reason is proximate to his seeking employment outside India, even if he does not have any employment outside India, but he's going outside India. Let's say I'm going outside India, and my intent is to complete my education and then get the get the job outside India. In that situation, I may avail of the benefit of not applying the 60 days limitation period, and instead I can apply the 182 days limitation period. But the income tax bill says for employment outside India. So that means I may be asked to demonstrate that I should actually have an employment in my hand when I'm traveling outside India. If I do not have that job in my hand, in that situation, I may not be given the benefit of this additional time limit. Further, think about a situation. Let's say I'm going outside India and my spouse is also coming with me, and as of now, she does not have any job. I may have a confirmed job. In that situation, for her, this 60 days limitation period may apply because she does not have a job in her hand, and she may or may not look for the employment outside India, even if she has an intent to go and look for an employment, but yet this benefit may not apply because she is not having any employment in her hand at the time of traveling outside India. So that's the only change in section 6. All other provisions remain the same. Income deemed to accrue or arise in India. So again, more or less the provision remains the same except three changes. One of them is a typo error. As you can see on your screen, I have strike through the word outside, and instead I have written the word in. Basically, what they have done, they have copied the content from subclause 2i and placed in subclause 3i. or wherein they couldn't change it to in India. So what is that? I'll just quickly explain it. So it basically talks about the taxation of the royalty payable by the non-resident. So if when a non-resident is paying any royalty for making or earning any income from any source outside India, it shall be deemed to across in India. It does not make any sense. Basically, it should be in India. This outside India makes sense when the royalty is being payable by a resident person for making or earning any income from any source outside India, and that is the same provision we have section 9. So basically, this is a typo error which I believe will be fixed whenever we see either the amended version of the bill after the standing committee report and before it becomes an act. Another change is in clause 96A 2I, wherein the underlined word has been removed. It says the Income Tax Act says the royalty payable in respect of any right, property, or information used or services utilized for the purpose of, and now instead of it, it uses the term payable for the business or profession carried on by a resident outside India. Since we have an extensive definition of the term royalty in section 9, by removing these words, it's not going to have much impact on the interpretation or the taxability. So these two changes are not much relevant. But the third one is really important. And the third one is, as you know, if all the business operations are not carried out in India, then the profit as reasonably attributable to the operation carried out in India shall be deemed to accrue or arise in India from the business connection. So this is the current provision wherein the word used is reasonably attributable. And how do you identify the reasonably attributable? For that, we have Rule 10, wherein it covers the three methods to determine the income that should be deemed as reasonably attributable to the business carried out in India, which is basically the presumptive, a proportionate, and the discretionary, wherein a discretion has been given to the assessing officer to determine the profit reasonably attributable to the business operation in India. But in the income tax bill, the word reasonably attributable has been replaced with just with the word attributable, wherein the word reasonably has been removed completely. So it gives an indication that we'll have a rule similar to Rule 10, which will have just two methodology. One is the presumptive and the second one is the proportionate method. The discretion given to the AO possibly would be removed entirely from corresponding Rule 10 in the income tax bill. So that's the another change in section 9. Now coming to the DTAA. So in DTAA section 90, we have section 159. The provision is almost the same except a few changes. So what are these changes? So as you know, in section 90, it says that if a term is not defined in the double taxation avoidance agreement, then the meaning of it as given in the Income Tax Act shall be considered. If that word is not defined even in the Income Tax Act, then the meaning as given in any notification issued by the central government shall be considered to interpret the meaning of a term used in the DTAA. But the income tax bill has gone two steps beyond, wherein not just the Income Tax Act as well as the notification issued by the central government, the income tax bill proposes that if a word not defined either in the Income Tax Act nor in the notification issued by the central government, but used in the DTAA, the meaning of it can be derived by looking at any central act enacted by the central government which is relating to the taxes, right? So giving an example, we have GST, we have custom, which is dealing with the taxes. So if a word is not defined in the DTAA or the Income Tax Act or any notification, in that situation, we can refer to the meaning of those terms for the purpose of DTAA only, as per the meaning defined in the central act relating to the taxes. So just think of an example wherein the word used is supply or services or goods. These words, if not defined in the Income Tax Act or the notification, then we can look at the IGST Act or the CGST Act to look at the meaning of these terms while interpreting any particular term of the DTAA. Now, even if a word is not defined in the central act relating to the taxes, then we can even refer to any other central act, even if not dealing with the taxes, to define the meaning of a term used in the DTAA. So now you can see that the government has given the wide power to itself to define the meaning of, to refer to any particular act for the meaning of a term used in the DTAA. But I don't know if, how far it would be tenable in the courts, because the agreement will always have the overriding power, overriding effect of the Income Tax Act if a word is not defined in the DTAA, but in general parlance. If in general parlance, it may have a different meaning, the court may take a liberal view in favor of the SSC, but we have to see it on a case to case basis. Coming to the next point, which is salary. So earlier we had section 10, which defined all the exemptions for the allowance and the retirement benefits, which are allowed from the salary income. Now they have been consolidated and have been brought into one single section. In terms of real change, real impact, they have removed the deduction for the entertainment allowance, which is basically allowed to the government employee. And as per in the current Income Tax Act, this entertainment allowance is allowed as a deduction under Section 16 up to 20% of the salary or the 5,000. This has been removed from the income tax bill. Now coming to the next point, which is basically, I would say, a cosmetic change, or it has no practical relevance even in the Income Tax Act. So it says, since the income tax returns you file these days are annexionless, every information the department wants to fetch from you, they ask you to fill in the schedule. There is no option to attach it with any document, any copy with the return of income. But the Income Tax Act contained a provision that in case of a medical treatment for the prescribed disease provided to an employee or his family member in an approved hospital and is not a taxable perquisite, provided a certificate from the hospital and a payment receipt are attached with the return of income. Since we do not have any option now to attach something with the ITR, this change has been proposed in the income tax bill to remove this requirement. And the next point, which I would say goes in favor of the employee. So the existing Income Tax Act says if the employer provides a vehicle to the employee to commute between the home and the office, it is not a taxable perquisite, right? So earlier it was not clear if that vehicle should be owned by the employer or not, but the income tax bill now writes it very, very clearly that even if employer owns that vehicle or he uses a third party vehicle and he's making a reimbursement of the expenses, even that in that situation it will be tax free perquisite if the vehicle is being used by the employee to commute between home and the office and not for any other purposes. All other things remain same in the chapter relating to salary. Coming to the next point, which is house property. Again, in house property, we could find only one change. In Income Tax Act, we have a provision which says if you have a house property which you may occupy for your business or profession, then its annual value is not taxable. And the word may occupy has been defined by the Mumbai ITAT in the case of Trackstar investment, where it says it covers cases which wherein a property is kept ready for business use but not occupied all the time. And the ITB replaces the word may occupy with the word occupied, which now may result in the taxability of properties that are ready for business but not actively occupied. A temporary occupation, temporary halt in the occupation of a building may, I believe, may not impact the classification of such property in the under the head of house property. But if you have a property ready, but you are not in a situation to occupy it because any other reason, but even if you have an intent to occupy it, it may not be classified under the head of house property. We may see some litigation on this aspect. How do you define it? How do you define the temporary occupation, halt in the occupation, and how do you distinguish between may occupy and the word occupied? The another change is, and I would say that is much needed, because this time they have tried to bring clarity in the law to bring to end litigation wherein a property has remained vacant for any period during the tax year. So it says that if a property, house property has remained vacant for any period, even let's say for even for a month, your property remained vacant, then in that situation you don't compare, you don't get into that complex calculation of first calculating the gross annual value, comparing it with the vacancy allowance. So things are pretty simple. If your property has remained vacant even for any period during the tax year, then you completely ignore the vacancy allowance and simply look at the actual rent you have received, and that would be the base for calculation of the income from house property, right? And now you don't need to compare your actual rent with the expected rent to compute your income from house property. Coming to the business income, I'll start with the present tax scheme. So the present tax scheme for the residents are consolidated into one section. Now you will see a lot of tables in the income tax bill. What they have done earlier, as you see, we have 44 ADA, ADA, we have 44 B, double B, double BA. Now we have BBC and BBD. So every provision may contain some additional points or may remove some of the points. Just give you an example. As you can see, 44 other than 44 BBC and the one which has been proposed by the Finance Bill 2025, 44 BBD. These two provisions do not give you any option to reject the presumptive income as provided by this provision and ask for the audit of your books of account and offer your income to tax on basis of actual computation. These two provisions do not have that option, and all other provisions give you an option to get your books audited under section 44AB and ignore the presumptive income as given by these sections and offer your income on actual basis. But this problem has been resolved in this income tax bill, wherein they have given everything in the form of a table. Now you can get your accounts audited and avoid computing the income on presumptive basis and offer your income on actual basis. However, the problem still remains the same in respect to 44 BBD. I would say it could be an oversight because 44 BBD has been introduced in this budget, and possibly this bill was drafted before this budget was presented. So possibly, I believe that problem will also be sorted in the subsequent when the subsequent development happens, wherein the audit option can also be given in the case of 44 BBD. Presumptive taxation scheme for non-resident also consolidated into one section with certain changes, which I've already mentioned. Now coming to the next point, non-resident engaged in the business of shipping an aircraft can declare income lower than the, I have covered this 44 BBD, I've already explained this. Coming to the next point, section 43B, which is corresponding to clause 4037 of the ITB. So as you know, in section 48(2)(I) by the budget 2022, a clarification was added that the Income Tax Act shall include a surcharge. So if you have made a payment and surcharge and assess, and then you were just making a disallowance of the income tax, not the surcharge, then after this amendment, it was made clear that the surcharge will also be disallowed. A similar amendment has been proposed in clause 37, which is 43B, wherein the income tax, the tax will also include the surcharge. So if you don't make a payment of a surcharge, no deduction can be claimed of it if it is basically it's an allowable deduction under section 43B. Coming to the next point, ITB clarifies that the tax paid on any income, including foreign taxes, eligible for credit cannot be claimed as business expenses. Earlier, only taxes paid on profit and gains for business and profession were not allowed that deduction. So it means every taxes which you have paid outside India now cannot be claimed as a deduction. Earlier, this prohibition was only on the taxes paid on the profit and gains from the business and profession. The ITB proposes that the actual cost of an asset will exclude the GST if the input tax credit is claimed, though it is logical, but now they have put it explicitly. Depreciation on intangible asset not fully used for the business will be allowed only proportionately as determined by the IO. So giving you context. So we have currently section 38, which says if you're not using any asset exclusively for your business purposes, but for your personal purposes as well, in that situation, you have to claim the deduction on a proportionate basis, right? Including the depreciation. And now we have a similar provision in respect of the intangible asset. We say the depreciation on the intangible asset, if you're not using exclusively for your business, but for your personal purposes as well, in that situation, you have to claim the deduction only the proportionate amount. So just take an example. Let's say you buy a mobile phone or you buy any software, and which you use it both for business purposes as well as personal purposes. So in that situation, you may be asked to compute not the mobile basically is not an intangible asset, it's a tangible asset. But let's think about uh, a software which, let's say, you have paid the software for lifetime license, and you have calculated that it would last at least for 5 years, and you are claiming a depreciation on it at the rate of 40%, or 25% as the case may be. In that situation, you have to claim the proportionate deduction, and the remaining proportionate deduction should be disallowed. Now, coming to the next point, assessee engaged in specified business are allowed 100% deduction under Section 35 AD of the Income Tax Act of the capital expenditure incurred for such businesses. Basically, these specified businesses are cold chain facilities, hospitals, and hotels. If such an asset is later sold or transferred, the amount received is taxed as business income under Section 28. So this is pretty logical. If you claim 100% deductions of any capital expenditure and later on you sell it, it would be taxable as a business income under Section 28. That's the existing provision. Right. This 100% deduction for the capital expenditure has been retained in clause 46 of the ITB. However, the taxability on the transfer of such asset is retained in clause 27 of the ITB. The taxability shall arise only if the deduction is claimed under clause 46 of the ITB. It does not explicitly cover assets for which deduction was claimed under Section 35 AD. So basically, it seems this is an oversight that could be rectified subsequently. All export incentive are covered under the scope of business income, which is corresponding to Section 28. So every kind of export incentive you have earned will now be taxable as business income. Another change we have is in Section 44 AB, wherein they have narrowed down the scope of the provision. So earlier there was a provision that if the total turnover is up to 10 crore rupees and the 95% of all receipts and payments are done through the banking channel, in that situation, you may not be required to get your accounts audited. But in the income tax bill, instead of saying 95% of all receipts and payment, it uses the word all the receipts and payment from business will be considered for the 95% threshold. So it means all your receipts and payment which are not connected to business operation, like your dividend or interest income, will not be included while computing this 95% threshold. So that is the another change they have made, they have proposed in the income tax bill, wherein more people may be asked to get their accounts audited if their business receipt is not meeting the threshold of 95%. Now, coming to the next point. So we have a provision in the chapter of capital gain, wherein the section 47, certain transfer of the foreign fund to the IFSC. It is a tax neutral transaction if this transaction happens on or before 31st March 2025. Ironically, this amendment has already been proposed by the Finance Bill 2025, wherein this outer date has been extended to March 31st, 2030. But the income tax bill retains the same period of March 31st, 2025 instead of March 31st, 2030. I believe, again, this is an oversight that could be rectified in subsequent developments. And why I believe it so? Because when we compared all the provisions of the income tax bill with the Income Tax Act as amended by the Finance Bill 2025, so we found so many changes which have been proposed by the Finance Bill 2025, which has now been included in the Income Tax Bill. So if you compare it with the Income Tax Act as amended by the Finance Number 2 Act 2024, so you'll find a lot of changes, but many of these changes have already been captured by the Finance Bill 2025. Now coming to the next point. So as you know, the last budget, the long-term capital gain has been made uniform for all the taxpayer. Now it is 12.5%, right? So there is one change which we could spot in the Income Tax Bill versus Income Tax Act. So before the amendment by the Finance Number 2 Act 2024, the capital gain from unlisted shares and debentures were taxable at the rate of 10% in the case of a non-resident without taking the benefit of first proviso which basically allows the currency translation benefit. The Finance Act 2024 introduced a standard tax rate of 12.5% on long-term capital gain, including these unlisted shares and the debentures transferred by the non-resident, but did not allow the benefit of the first provision. It was logical. Since the tax rates remain the same, the calculation mechanism should remain the same for all the taxpayer, whether he's a resident or a non-resident. But I don't know, it's an oversight of what the income tax bill proposes to allow the non-resident to compute the long-term capital gain from the unlisted share debentures of the Indian company in foreign currency. In other words, the non-resident can now compute the taxes as per the first proviso of taxation section 48, wherein they can compute the capital gain in foreign currency and then translate it into INR, yet pay tax at the rate of 12.5%. So earlier in the Income Tax Act, after the Finance Act 2024, they have removed the indexation benefit and they have removed the foreign currency translation benefit, and instead they have given the tax rate of 12.5%. But now one of this foreign currency translation benefit has been reintroduced in the income tax bill. All right, coming to the next point, the Income Tax Act clearly mentioned that any long-term capital asset transferred on or after 23rd July 2024 shall be taxable at a uniform rate of 12.5%. The income tax bill does not mention anything about this cutoff date, and this is logical because this new bill is coming into force from 1st April 2026. So it was not logical to mention something of the earlier date. And since we already have the Income Tax Act, which mentions this date, and all these transactions happens until 31st March 2026 shall be dealt with as per the Income Tax Act 1961. And the same thing has been mentioned in the clause 536, which is the repeal and the saving clause. The fourth point, which is quite confusing. In fact, we could not find out why they have given the power to the government to prescribe the cases where the indexation benefit shall be allowed. Since I couldn't find out even a single case wherein the indexation benefit is allowed, except when you transfer an immovable property which were acquired on or before 22nd July 2024 and transferred on or after 23rd July 2024. In that situation, you have an option to compute the capital gain after taking the indexation benefit. And that provision still remain in the income tax bill. But why they have given an additional power to the government to specify the circumstances wherein the indexation benefit shall be given, I have no idea why they have written this power. Coming to the next point. In the next point, they have simply bring the time limitation, the limitation period at par. So earlier we had two time limits in section 54F, within 1 year from the date of transfer and the 2 years. These are two in different contexts. Now they have brought both at the 2 years. So I'm skipping this part. AMT and MAT. So, so when you convert a private company into an LLP, so all your MAT credit shall lapse. Again, this is logical. But in the income tax bill, what they have done, they have consolidated the provision of MAT and AMT, and because of the unclear wording, so it seems the AMT provision will not apply to the successor LLP. So this does not seem to be the intent. So giving you an example, let's say my a company has been converted into an LLP. So earlier the AMT shall apply to that LLP instead of MAT, and the MAT credit shall lapse. But the income tax bill says the AMT provisions will not apply at all to the successor LLP. Again, this is not the right intent. Possibly we'll have some changes in this provision when this becomes an act. Alternative tax regimes. So section 115 BAB, it empowers the CBD to issue guidelines with the approval of the central government to address any difficulties in fulfilling the condition of the provision. Such guidelines are required to be laid before each house of the parliament. However, no such power is provided under section 115 BAE. The ITB proposes to give the CBDT the power to issue guidelines for clause 204, which is corresponding to section 115 BAE, which is similar to section 115 BAB of the Income Tax Act. So it is not going to have much impact. So it's nothing here for discussion. No guidelines shall be issued under these both clauses 201 and 204 after 2 years from 1st April 2026. Now coming to the next point. So uh, if a company is opting for 115 BAA, which is the alternate tax regime, then it cannot claim a deduction for the inter-corporate dividend under section 148 of the ITB, which is corresponding to section 80M of the ITA. Again, this seems to be an error which can be rectified subsequently. So as I mentioned earlier, TDS and TCS, they have been consolidated into one section. So now we just have 9 sections dealing with all the provisions relating to the TDS and TCS. So and now from the next year, once it becomes an act, we'll not find some TDS provision within the section and some TDS rates within the part 2 of the first schedule of the Finance Act. And it has always been very confusing for me when I became a chartered accountant. I was not able to find out the TDS rate for certain transactions because I have to check the Finance Act, that part 2 of first schedule to find out the relevant TDS rate. But now what they have done, they have brought everything relating to the TDS and TCS, the rates within the section itself. So just similar to that part 2 table, they have introduced 3 tables in the section itself, wherein they have specified the TDS rates and other important provisions, wherein you are making a payment to residents or non-residents or any other person. So we have one single table containing TDS rates, threshold, and the payment nature. TCS provisions are also consolidated into a single table for easy readability. So in currently we have 206C, wherein we have rates in 206C subsection 1, then 1G, 1H, 1F. So we have got 1H has been omitted, but we have multiple subsection containing the multiple rates. Now they have brought them together into one table. That TDS on payment credit to suspense account, you may not find the suspense account discussion in many provisions of the current Income Tax Act. But now, since they have consolidated into one provision, you will find the suspense account provision applicable to every provision, every transaction, every TDS transaction. And a lower TDS and TCS certificate is available for all payments. So the current Income Tax Act does not contain certain sections for which you can apply TDS and TCS certificate, but now you can apply for all the TDS and TCS certificate if you're able to justify. The another point is, as you remember, 3 years back, we had an amendment wherein the government has given the option to the employee to defer the payment of taxes on ESOPs up to 48 months, obviously from the date of until they resign from the employment or they liquidate their holding. Up to 48, they can defer the payment of tax payments on their ESOPs. This 48 months has been extended to 60 months in the income tax bill. Coming to the returns. So in Income Tax Act, we have a 7th proviso, which requires you to file the return of income, even if your income is below the maximum exemption limit. But let's say you have income, some expenditure on foreign travel. There are a lot of other scenarios as well, like your gross receipt exceeds the threshold limits. The 7th proviso has been proposed to be removed from the income tax bill, and instead the more powers have been given to the board to specify the condition whenever they may require any class of taxpayers to file the return of income. So since it's not easy to amend the Income Tax Act, that's a long process. So whenever these powers are given to the board, so anytime they can issue notification and they may ask any particular class of taxpayers to file the return of income. Just think about a situation. Let's say you are making an investment in the crypto assets like bitcoins. They simply ask you, it becomes mandatory for them, even if you have invested a few $1,000 in bitcoins, it becomes mandatory for you to file the return of income. They can do that. So this is the power of these powers are so wide given to the board. Now they can specify any condition, any situation wherein they can ask you to file the return of income. The next point is the board has been given power to seek the details of your credit card, all the expenditure exceeding the threshold, the remittances you have made, the particulars of your principal place of business. Again, these powers are very wide. They may ask you to furnish every credit card, every expenditure you have incurred using those credit cards, and these powers can be used to synchronize, to match your expenditure versus your income, because these credit card the credit cards details are captured in the SFT only when it is exceeding the SFTs. Now they can ask you to furnish details of all your credit cards. Again, the third point seems to be an error. Curated return. So when you file an updated return, all the subsequent returns they may be impacted because of your updated return you have filed for the previous year. It could impact your carry forward losses and the unabsorbed depreciation. Since to handle that situation, you can file a curated return. And last year or maybe before that, this amendment was made in the Income Tax Act. Now, but the income tax bill does not contain a corresponding provision. So we believe it's an error that will be sorted out. Coming to the assessment. So in assessment, not much changes except the powers of the valuation officer, which currently are given in section 38 of the repealed Wealth Tax Act 1957. All these powers have been included within the income tax bill. You don't need to refer to the Wealth Tax Act for these powers now. The valuation officer can now amend the valuation report issued by him to correct any mistake in accordance with clause 287 of the ITB, which is corresponding to section 154 of the IT Act. Section 144C. The current section 144C specify the elements the DRP must consider when issuing the directions. So the ITB, instead of listing out the specific items to consider, focuses on the structure and the content of the direction. It requires that the direction be in writing and must state the points of determination, the decision on each point, and the reasons for those decisions. Reassessment under section 147 to 151. So the scope of it, though I would say to some extent remain the same, but yet at certain places they have exceeded the scope of these provisions. So the explanation to section 147 of the Income Tax Act, it provides that the AO can assess or reassess all those incomes that come to his notice subsequently in the course of such proceedings, even if the procedure prescribed in section 148 was not followed. So let's say the assessing officer has issued a notice to tax two income, which the evidence in respect of which he found, and he has issued a notice 148A and the corresponding 148 to assess those income. But while doing the assessment, let's say he come across one additional income. So in that situation, he can assess that income without following the process of 148A. But in that situation, he has to follow the process of 148 and 151, which is getting the approval sanction from the authorities and issuing a notice under section 148. But the income tax bill gives the immunity from following these two process of 148 and 151. So it means if you come across any income which were not earlier part of the notice, you can assess them without following 148, 148A and 151 process. The ITB, so we have a meaning of the term information in section 148. If something falls within that definition, you can initiate the reassessment process. So now what they have done, they have added two more scenarios which would be considered as an information to initiate the reassessment. So which is basically the directions given by the approving panel to invoke the guard, basically to declare the arrangement as an impermissible avoidance arrangement, or any finding or directions contained in any order passed by any authority in any proceeding under this act by way of an appeal, reference, or revision of, and the last one is very important, by a court in any proceeding under any law. So just think about a situation wherein a decision has been passed against you under the Customs Act or the GST Act, and because of that certain income could be taxed in your hand. That direction, that order by the court can be considered as an information to initiate the reassessment. Now coming to the next point, which is the e-verification scheme. So ITA provides that if AO receives information in a faceless manner in the e-verification scheme, the notice can be issued without following the procedure under section 148A. So in situation, prior approval of the specified authority is mandatory before issuing the notice under section 148. So again, in this scenario, two situations have been added. In these situations are the same as I just mentioned in the previous points, wherein the approving panel invoking the GAR or the finding or directions contained in any order of the authorities or the court. This next point is very important. So earlier we didn't have any limitation period. The minimum limit. You were saying something? All right, I'll continue. So earlier we didn't have any minimum lock-in window. Before that, you cannot issue a notice under section 148 or 148A. The income tax bill proposes that before the 1 year and from the end of the tax year. So in our context, it means until the assessment year ends, you cannot issue a notice under section 148 and the 148A. Section 150 of the Income Tax Act provides that the notice under Section 148 for reassessment may be issued at any time for the purpose of giving effect to any finding or direction contained in any order passed by an authority in any proceeding by way of appeal, reference, or revision or by a court. A new circumstances has been added in this corresponding clause 283 of the ITB, where the limitation period shall also not apply wherein directions are given by the approving panel declaring the arrangement as an impermissible avoidance arrangement. There is no change in the limitation period to complete the assessment, except that the limitation period to give effect to the appeal results has been extended from 3 months to 6 months, while the total limitation period after the extension shall remain 9 months. Now coming to the block assessment. So again, one change which has been proposed by the Finance Bill 2025, which has not been carried in the income tax bill. So to complete the block assessment, the current limitation period is 12 months from the end of the month in which the last of the authorization for a search or acquisition was executed or made. So the finance bill has basically extended this limitation period from 12 months from the end of the month to 12 months from the end of the quarter in which the last authorization for search or requisition was executed. The ITB, I don't know why they have retained the original time limit of 12 months from the end of the month. And the last authorization for a search or acquisition was executed or made. So I believe before it becomes an act, it would be restored back to 12 months from the end of the quarter, not the month. In unexplained income, not much changes except the clubbing of the provisions. And in respect of the hundi, when you borrow on a hundi or repayment of a hundi loan other than through account paid check or the allowed banking channels, it is considered as the taxable income, the unexplained income. Now the income tax bill proposes to cover some other negotiable instruments as well. In penalties, we could find much changes, except as you know, we have 274, which lays down the procedure to invoke the penalty, wherein it requires giving an opportunity of being heard to the assessee before initiating the penalty proceedings. At the same time, we already had this provision of giving the opportunity of being heard to the assessee in multiple other penalty provisions. But the income tax bill proposes to remove that duplicate reference of giving an opportunity of being heard to the assessee at all these other provisions, and rather they mention it just one place, which is clause 71, which is corresponding to section 274 of the Income Tax Act. And the another point is the penalty under the prosecution under section 276 triple C, which is corresponding to clause 480 of the income tax bill, which basically proposes to prosecute the tax assessee for failure to furnish the return of income. It has been made non-cognizable. Earlier, it was a cognizable offense. Search and seizure. In search and seizure, all the changes they have made, they have expanded the scope of the term books of account and other documents, and now it covers each and everything which belongs to you, whether in the form of a digital content or in the form of physical content. The physical content were earlier already part of the books of documents and the other books of account and the other documents. Now it covers every information stored in electronic media or the computer system. So the computer system covers everything you can think about, be it your computer, hard disk, floppy drive, CD, DVD, pen drive, your cloud, everything you have which is in the electronic media form can now be searched and seized. When it comes to the virtual digital space, because your computer system would cover the virtual digital space, and virtual digital space would mean again your email account, your social media account, your online cloud, everything. They can ask you to give them the access. There have been discussion on this point that this is the breach of the right to privacy. So I'm not going into that discussion, but I'm just telling you that the department, if the constitutional validity of this thing has been approved by the Supreme Court, so the impact of it would be that the government, the department can ask you to give them the access of your all your social media, all your email accounts, all your clouds, and now they can go and check each and everything. So if I believe, if the government, if the authorities have the power to seize your computer system, why they should not have the power to seize your email account and the your social media account? If there is an argument of breach of private to right to privacy, that should also apply to your all other computer system, all your hard disk, all your pen drives too. I've already covered it. So just like they have the power to break open the lock of any door, box, locker, safe, or almirah, if the keys thereof are not available, the same powers had been given to them, wherein they can gain access to your email servers or your social media account. If they are not able to access it, they can override it by using the access code, by overriding your two-factor authentication. The same thing we have given for the presumptions. So all the presumptions as they have for your books of account and other documents, now it expands that presumption, the list of assets against which the legal presumption can be applied to now will include all your virtual digital assets, all your virtual digital space. So let's say you, there's a pen drive is found at your home which hard disk contains bitcoins, and a legal presumption shall be taken that all these bitcoins belong to you. So that is the impact of this legal presumption against the virtual digital assets and the virtual digital space. Because as you know, you can, if you buy a Bitcoin, you don't need any wallet. You can simply note down the code, note down your private key. Let's say you note down the private key in a MS Word and keep it in your cloud. So, and the government gets access to that key. So in that situation, it will be deemed, presumed that the virtual digital assets which are underlying those private key belong to you and you are the owner of that assets. And the another change is the ITB removes an additional director, additional commissioner, deputy director, and deputy commissioner from the list of authorities who can initiate a search. Again, as I've explained, the power of survey. So in power of survey, the key changes they have made is now during a survey, whenever they want to take a statement, now they can take the statement on oath. Earlier, there was no mandatory requirement or there was no provision to ask the person involved to give a statement on oath, because now they have given this power to the authority to take statement on oath. That means all those statements taken during the survey would have better legal validity in the court's proceedings and during the assessment proceedings. Okay, and I think so. I'll be sharing this PPT with you guys. You can have a look. I have covered all the important provisions which I believe should be highlighted for your attention. And just go through this PPT. If you come across any problem, any requirement, you may reach out to me. My email ID is naveen@textman.ai. Anyways, I'll share my email IDs with the organizers of this session. You can ask for my email ID and then you can reach out to me for any query you may have. I'll keep last 10 minutes for the Q&A session. This PPT I've already given to the organizers. They will circulate it with all the audience participants for these sessions. And I request, if you may have any query, you may ask me.
Hello. Hello. Thanks for the nice presentation, sir. I have it's a general question. This is regarding the benefit of a basic exemption limit. Okay. So now I understand in the old regime, the benefit of basic exemption limit is available in case of capital gains. Okay. 2,50,000. Suppose a senior person who does not have salary or pension, but he got only investment income. Okay. So he got long-term capital gain. So in that case, he can claim the 2,50,000 basic exemption limit along with that 1 lakh. that long-term capital gain exemption. Okay, so in total 3,50,000 he can claim. I hope please clarify whether the same thing continues even currently. The old regime also continues. Whether that benefit of basic exemption continues in old regime, and whether that is applicable in the new regime also.
Sir, if I reframe your question, and for my understanding, what I understood is you are talking about the old tax regime, not the new tax regime.
In both, I need clarity because earlier it was
Sir,
allowed.
this-
Old tax
sir,
regime it was allowed. Whether that continues now in old tax regime, moreover, whether that is applicable in new tax regime also.
So let's talk about the old tax regime first. So in the old tax regime, if you have a special income and your normal income is not sufficient to claim the maximum benefit of the basic exemption limit, in that situation for certain resident individuals and HUF, you can knock off your special income until your basic exemption limit is exhausted. So like 112A or 111A, I can use that income to exhaust my basic exemption limit under the old tax regime. That provision is remain the same in the new tax regime. Now coming to uh, in the income tax bill, now coming to the new tax regime, in new tax regime, that problem of allowing the 87A rebate from the special income, and so there has been an amendment in the section 87A by the Finance Bill 2025, wherein they have proposed a second proviso in Section 87A, and they have mentioned that the total rebate under Section 87 or the total tax rebate under Section 87A cannot exceed the tax liability as computed under Section 115 BAC subsection 1A. What does that mean? So that means whatever tax liability you may have on your normal income, not on the special income, and the tax liability computed as per 115 BAC 1A, your 87A rebate cannot exceed that. That problem has been sorted, but still there remains a problem, and that problem is the overall threshold limit for me to become eligible for 87A rebate is my total income should not exceed 12 lakh rupees, right? So if you open the first proviso to section 87A, it covers two subclauses, clause A and clause B. Clause A says if your income does not exceed 12 lakh rupees, you can claim 87A rebate up to 60,000 rupees. That problem is sorted. But the problem arises is when you go to the clause B says if your income exceeds 12 lakh rupees, in that situation, you can claim a marginal rebate. The problem is how do you compute your total income? The first proviso start with the term total income exceed or does not exceed as the case may be. The total income. So total income as we understand covers both normal income and the special income. But this terminology has got multiple meaning at multiple occasions. So as you know, there has been litigation going with the department, and it has been filed by, if I'm not wrong, Chamber of Tax Consultants (CTC), wherein they have raised this issue of not allowing the 87A rebate from this tax payable on the special income. During the argument presented by the government, by the department to the court, was that the special income should be excluded both for computing the threshold limit of earlier 7 lakh as well as for computation of the rebate. So if you apply that logic, so if my total income, let's say, is 20 lakh rupees, my income is 20 lakh rupees, 8 lakh is my long-term capital gain, and 12 lakh is my special income, is my normal income, my salary income. So what does that mean? Should I claim the rebate under section 87A because I completely ignore my special income and just focus only on the normal income? And since the normal income is up to 12 lakh rupees, my entire income should be eligible for 87A rebate. It means I will be liable to pay tax only on 8 lakh rupees, which is, let's say, 112A, which is 12.5%. So it means I should pay tax only on the long-term capital gain. That's controversy still remains the same. But if you go by the department's logic, this whatever example I have taken should be considered as it is, and we have verified it both from the argument taken by the department in that litigation, as well as in the utility, the return filing utility, wherein they completely ignore the special income both for computing the threshold income and both for the calculation of the rebate. So this treatment under the Income Tax Act remains the same under the income tax bill. So I hope it answers your query. Rather, it gives you sufficient food for thought. What is the problem? What is the dispute? And why we still do not have any clarity on this aspect? What will happen in case a special income is forming part of the total income? Any other question?
1 second.
Sir, I have a practical question whereby if a non-resident Indian, if he's not having any income in India, but still residing in a country where there is no tax, direct taxes liability. So in which case he will not be liable for direct taxes in India because he's not having any Indian income. In the present income tax act 1961, is the same situation applies in the new income tax bill?
If I reframe your query, you are saying if a non-resident is not having any income in India, then he will not have any tax liability in India, right? This is your question.
Yes.
Yes, ma'am.
But if he's residing in a country where there's no direct tax liability in that country, is it because I came to know that in this case where there's no direct tax liability in the country where he resides, there's a concept of deemed residency in new income tax bill.
But talking about Section 6, so Budget 2020-21 introduced this provision wherein they have introduced that limitation period of 15 lakh rupees. If your income exceeding 50 Indian income exceeding 15 lakh rupees and you're not resident in any other country, you'll be deemed as a deemed resident in India, which is basically not ordinary resident in India. That you're talking about that provision of Section 6. If I'm not wrong, this is Section 6(1)(a). As long as I remember, this provision is still there in the Income Tax Bill 2025. Any other query?
Thank you for the presentation. Just to take over from what the previous query was raised. Not mistaken, it is
Sir, can you speak a little louder and repeat your query?
yeah. Thank you for the nice presentation. Just to carry over from what the previous query she asked. I think the basic premises is 15 lakhs and above. Otherwise, it will not be applicable, right?
Right.
Yeah, 15 lakhs threshold for the purpose of bringing people into the tax net. The basic premise was people who have Indian income arising in India of 15 lakhs and above and they're not falling in any other tax jurisdiction. To bring them into the tax net, that provision was introduced. So the same thing continues, right? Okay, so this is what you clarified now. Because,
Yes. The provision remains the same. Yes, she was talking about that situation of income exceeding 15 lakh rupees and you're not considered a resident of any other country because of your domicile or because of any other factors. In that situation, if you are an Indian citizen, then you will be deemed as the resident of India, but your status would be not ordinary resident in India.
if the person doesn't have any income arising in India, the situation doesn't.
So that provision still remains the same. That provision we have in Section 5 and the Clause 5 of the Income Tax Bill, that position remains the same. There is no change at all in the scope of income.
And can you please clarify regarding the residential status? You mentioned, I think, during also for presentation, you mentioned about the distinction between spouse.
Sir, in Section 6, I defined the change pertaining to changing the term for the purpose of employment for employment outside India. That's the only change. There is no other change, neither in Section 5 or 4 or Section 6 or Section 9. In section 9, I have already explained you, except the word attributable, there is no other change. In section 9, for the purpose of employment is changed with for employment outside India, and there is no change at all in section 4 or section 5. Right. So your scope of income, the taxability of non-resident in India still remains the same.
No, so that means 180 days, not the 60 days, no? When it's 60 days and above, they will not be considered as resident in India.
Sir,
They stay for more than 60 days and then travel abroad.
sir, that provision is still there in the Income Tax Act. That 60 days stay of for 60 days or more in the current year is still there. The only change is in the Income Tax Act, it says this condition of 60 days will not apply to an Indian citizen who is traveling outside India for the purpose of employment outside India. In that situation, he will have to comply with condition of stay in India for 182 days or more in India in the current year, right? So we have this provision in the Income Tax Act. The Income Tax Bill proposes that this 60 days condition will not apply to you, and rather 182 days condition will apply. Till here, Income Tax Act and Income Tax Bill are on the same page, except one change, and that change is you must be going outside India for employment, not for the purpose of employment. Means my intent is to go outside India to venture out to just to look for the jobs if I may have it. In that situation, I will have this benefit of 182 days and not 60 days. But now, until I have a confirmed job opportunity in my hand, the department may not allow me that additional period of 182 days. In that situation, they may, if I might stay in India for more than 60 days, they may consider me as resident Indian, not resident in India. So that's the only change, sir. And possibly I may not be able to answer your question correctly because sometimes I am not able to understand because of the sound quality of the mic you are using. So if still do you think I am not in a situation, I am not answering your question properly, I suggest you to write me an email with your query, and I'll either write you an email back or I'll give you a call.
I think it's been clarified. Thank you.
Any more queries? That's it, sir.
So, sir, should we end this presentation?
Yes, sir. Thank you for this information and engaging session, sir. We look forward to host you in person for a future session, sir. So it was very, the clarity you brought to the topic was very good, sir. Thank you for this wonderful session.
My pleasure. I really enjoyed speaking during this event, sir. My pleasure.
Thank you, sir. Once again, thank you on behalf of the everybody had lunch. So we'll be beginning the second half of the first session today. So today we have a distinguished CA SAMSUDEEN sir with us. So to be for the second session, sir, please request you to come to the dais. Thank you, sir. Before we begin, I would like to give a short summary of CS Samsudeen sir. He has a vast experience in auditing, taxation, and financial consultants in public and private sector. With a career spanning decades, CS Samsudeen has contributed immensely through statutory audits in major banks like SBI, Syndicate Bank, and Corporate Bank. He is also auditing in private sector firms including Algam Agro Limited, etc. Beyond his professional achievements, he has also involved in seminars and training programs, sharing in knowledge in transfer pricing, bank audits, and accounting standards. On behalf of everyone present, I extend a warm welcome to CS Samsudeen sir and look forward to have a insightful session with him. As a token of appreciation, I would like to invite CA Mukundan sir to present a memento to our chief guest. So the second section will be regarding this PGBP and its implication. I mean, its deductions and depreciation, everything. And so according to the new tax bill. So sir, I request you to start the sessions. Thank you, sir.
Very good afternoon to fellow members. I take this opportunity for having given this opportunity by the chairperson of Southern India Regional Council of the Institute of Chartered Accountants of India, Ms. Revati Raghunathan, and his team warmly hosted me for giving this presentation in front of the members in this afternoon session. We all know the subject is still in incubation, and of course the very subject is core subject relevant to all of us, the Income Tax Act, where income is the matter and tax is the relatively the consequent subject, where administration is handled through income tax bill. So we are all interested in income calculation through this new income tax bill 2025 presented in the parliament last month. I couldn't find much difference between the earlier or the existing Income Tax Act and the proposed Income Tax Bill 2025. But the government at its wisdom thought it fit that the entire existing legislation should be codified in a more logical structure to meet the reading requirements of the present generation and coming generation, without diluting any of the contents in the existing legislation and the draftsman skills of the earlier generation. We all should believe that the new structure of the bill is giving more clarity, more lucid, and the intended purpose of looking at and reading at the legislation at a glance in a holistic manner, as well as the segment or reference very quickly. When I look at how lucid it was and how precisely it is restructured, the executive summary of the new bill gives that words have been reduced from 512,000 to 259,000, which is about 50%. The very content or the very words has been reduced by 50%. Definitely, one can quickly understand the legislation with 50% of his time. Chapters have been reduced from 47 to 23. Sections have been reduced from 819 to 536. 819 to 536. 819, of course, we all came to know only after it is introduced in the parliament. Before that, we all believe that Income Tax Act 1961 is giving only 298 sections. Of course, 112, there is a series. 44, there is a series. And 194, there is a very extensive series. and like that 115, 112, a lot of extensions. Now we all believe that earlier we had 819 sections and now it is reduced to 536, and therefore nobody, no citizen, no taxpayer should quarrel that it is increased from 298 to 536. It is reduced from 816 to 536, 819 to 536. And the tables have been added. And the very nomenclature is getting popularized now. The tables, the formulas, and formula concept has been brought into the income tax bill. Yeah. Earlier, 6 formula have been there. Now it is increased to 46 formula in the respective places, because now we are going to talk about accounts, and accounts is some numerical formula, sales minus purchases or sales minus cost of goods sold is the profit, gross profit, and reduced by expenses is giving net profit. So some sort of formula, numerics will be eased by giving formula. That is what the executive wisdom felt, and therefore they brought a formula in the income tax bill. And executives, bureaucrats have given 30 frequently asked questions, answers to frequently asked questions in the form of executive circulars. And we understand that about 20,976 online queries have been attended before formulating this particular bill. New income tax, now we have about 600 pages, 536 sections, 23 chapters, 16 schedules, because many of our provisions have been put into annexes in the form of schedules, especially section 10 exemptions. Section 10 exemption is basically one section is given as 6 schedules. Of course, for everything there is a segment, there is purpose, and there is a quick reference, and therefore quick reference is possible because of that. Motives, our government told it is ease of compliance. That is the motives, because the very purpose is to quickly comply by the taxpayer, either through their tax practitioners or through by themselves, because most of the taxpayers are individuals and individual salaried employees of public sector as well as organized sector, and the proprietor individuals who are more in number, of course less in tax quantum, but more in number, they can quickly understand. That is what is brought out. Some new phrases have been brought out. One important phrase which is more relevant for accountants like ours is the words assessment year and the previous year have been expected to be scrapped from the income tax book, and the word tax year is going to be brought. Of course, we have many years: academic year, calendar year, lunar year, and things are coming now. We should unlearn this assessment year the very old concept of previous year. Previous year, the very word is not that much receptive to many people, because I am paying tax, and why I am paying tax by telling previous year, because I was paying 90% of my tax in advance, and most of my tax is collected in the form of tax deducted source. When I file my return, I am told that I am filing the return for previous year, and therefore previous year concept, previous year word is going to be scrapped. Now let's come to the topic assigned to me. The topic assigned to me is profits and gains of business or profession, how it should be computed for the purpose of filing income tax return, to calculate income tax liability on the profit. See, we all know that how profit and loss account is being prepared, because in accountancy, most of our job is to calculate profit from the P&L account, and therefore we are all well versed in profit. But how it should be regulated, because there should be some sort of uniformity, there should be some sort of consistency, and there should be some facility for administration of those numerics, how it should be handled. Now, for the last more than 10 years or more than 12 years, these accounting standards are accepted in income tax also. Accounting standards, they say in the form of ICDS. Now we say, even before that, accounting standards. Now it is IND AS, and some say IFRS standards. Anyway, the accounting, the profit and loss account preparation is guided through ICDS, accounting standards, or IND AS, which is very much necessary, and any deviation from one year to another we should disclose in our audit reports, in ITR also, and therefore following accounting standards even to non-corporate entities and the proprietors also becoming mandatory, subject to some levels, level 1 indicators, level 2 indicators, level 3, level 4, 4 categories of entities to follow accounting standards. And from next year onward, from this 1/4/2024, accounts commencing from 1/4/2024 onwards, non-corporate entities must prepare their accounts in accordance with the guidance note formats. Institute already issued guidance note giving the balance sheet formats for non-corporate entities. That is very important. Non-corporate entities should give balance sheet with figures for the previous year. That is very important. So far, many of us may not be giving figures for the previous year for various reasons. But Now it is mandatory. It should be structured. There is no horizontal form of presentation of balance sheet, only vertical form of balance sheet. And there should be compulsory disclosure of notes forming part of accounts, where we should disclose significant accounting policies and related party disclosures and accounting matters relating to alternative accounting treatments are available. Wherever alternative accounting treatments are available, we should give it in the form of our policy, and the entity should follow consistency. And going concern is inevitable basic fundamental parameter which will be tested nowadays. And therefore, new balance sheet format is the pre-requirement which I am emphasizing for the purpose of calculating profit. Now we'll go to one by one how profits have been calculated. So law is not giving any format for preparing balance sheet. They say balance sheet and profit loss account. They say profit includes so and so, and expenses include so and so, but shall not include so and so, like that. Some embediments or conditions are put for claiming expenses. Some broadening of taking income. Broadening of taking income is basically discussed in section 28. Earlier 28, now it was 26, where small wordings only changes comes. When we interpret rightly, there is no much change, but because of wordings there can be interpretations. Profits includes profits and gains of any business or profession carried on by the assessee at any time during that tax year, any compensation or other payment due to or received by any person by whatever name called, wholly or substantially managing the affairs of an Indian company or in India of any other company, or holding any agency in India for any part of business activities of any other person, or for any contract relating to the business. So profit includes compensation received in respect of agency or contract also. So we should not what is called segment or keep it separate under some other head, or without consolidating those financials in the main P&L account. It should be part of P&L account. Then any compensation or payment due to or received by any person for vesting of the management of any of the property or business in the government, including the corporation owned and controlled by the government under any law in force. That means any compensation received from government in respect of property managed by them or a corporation owned by the government. Then income derived by trade, professional or similar association from specific services performed for its members. Then amount of any profit on sale of input license, that is earlier import license, now they call it input license. Cash assistance against export, duty drawback or duty remittance of any other export incentive received or receivable. The very same phrases, but the wordings are slightly changed. So all import related incentives and export related incentives should be accounted on accrual basis. Accrual is mandated, even though cash accounting is permitted in income tax. As far as these matters are concerned, it is on accrual basis, because the very charging section is inclusive and elaborating, telling that received and receivable should be part of especially export incentive, DPV, duty drawback related incentives should be accounted on the basis of exports, irrespective of money received subsequently. Just like a sales, in respect of incentives also it should be accounted. Likewise, import, irrespective of export commitment is made, when import license is received, its value should be accounted. And based on the sale, the increase or decrease can be adjusted in the profit and loss account. Value of any benefit or perquisite arising from the business or exercise of profession, whether convertible into money or in cash or in kind, or partly in cash or partly in kind. Value of any benefit or perquisite. See, so many pharma companies or agency companies are giving based on turnover incentive, based on turnover or other cash intake criteria. They give perquisite also, tours, travels, or coupons. All those are part of income, shall be credited into the P&L account. Then, what is called amount being interest, salary, bonus, commission, remuneration, by whatever name called, which is due to or received by a partner of a firm from such firm to the extent allowed by Chapter 4D as a deduction in computing income of the firm. That means allowable remuneration and allowable interest in the partnerships to the partners are liable to be included in the profits and gains of that particular partner. Okay. So this is applicable to individuals, because partnership firms are not earning any salary. Of course, partnership firms may be partner in partnerships, and interest earned thereon is as far as interest earned by partnership firm from another partnership firm is liable to be taxed under profits only, and is not income from other sources. Any sum received or receivable or in cash or in kind under an agreement for not carrying out a consideration received on account of a right to manufacture, etc. So, that means any the contractual arrangements based on which a right to manufacture is transferred and money is received, that is also part of profit and is liable to be assessed under profits and gains. Under an agreement for not being sharing any know-how, patent, copyright, trademark, license, franchise, or any other business or commercial right of similar nature, or information or technical know-how likely to assist in the manufacture or processing of goods or provision for services. So, any technical know-how, copyright, patent, if it is transferred or shared and money is received, that is part of profit liable to be credited in the P&L account and shown as income from business or profession. Any sum received under Keyman insurance policy, that is also part of income from business. Fair market value of inventory on the date on which it is converted into or treated as capital asset determined in a manner prescribed. So this is especially for real estates. Real estates, initially they will keep it as a capital asset, and subsequently they will convert it into stock in trade. Then at the time of converting into stock in trade, fair market value is to be taken, and difference between fair market value and the cost shall be credited to the P&L account in the year of conversion. any sum which is received or receivable in cash or in kind when a capital asset other than land or goodwill or financial instrument is demolished, destroyed or discarded or transferred. The whole of expenditure on it had been allowed as a deduction under section 46. Any money received in this context also should be taken as profit. So broadly I am focusing profit and loss account first should be prepared, and these are all the additional items which, if it was not accounted as a credit in the profit and loss account, is also to be taken. So this is only inclusive definition. Section 26, clause 26 is inclusive definition where these are all to be taken in addition to the profit taken already, if these items are not appearing in the P&L account. If it is already in the P&L account, okay, well, you prepared well. Then, manner of computing profits and gains of business or profession is described in clause 27, which mention the income referred to in section 26 shall be computed as per the provisions of section 28 to 60. Earlier it was 30 to 44. Now it is 28 to 60. So number is little large. Don't worry. The matter is very same, and many of the things are exceptional in nature. Therefore, I am telling again the concept of P&L. Profit and loss account is already prepared based on the accounting standards. By complying with the accounting standards, mostly it will be perfect. These are all only additional adjustments. Okay, what are being discussed in section 28? Proposed section 28 is discussing the following amount shall be allowed as a deduction in respect of premises, machinery, plant or furniture, wholly and exclusively used for the purpose of business. Any premium paid in respect of insurance. Insurance charges, no question. No, for the purpose of income tax, this prepaid insurance concept is not there. And therefore, for small traders or a small organization, this prepaid insurance etc. is not at all necessary. Whatever paid is allowable. Then land revenue, local taxes, municipal taxes. Local taxes, municipal taxes in respect of property owned by the SSC. Okay. So here one important point which I am telling, in respect of building construction, one time building tax is being levied by most states. It is not a municipal tax. It is a tax, revenue collected by the state government. This particular one-time tax is liable to be capitalized and shall not be charged to P&L account in the year of payment, because this is one-time tax. Just like as excise duty or import duty while purchasing the goods. This is in respect of immovable property, which you please keep it in mind. Rent paid when the premises are occupied by the SSC as a tenant. So, rent. Current repairs. Cost of repairs. See, current repairs by the tenant, cost of repairs by the owner. So, cost of repairs means if owner didn't make a repair regularly and large repair cost is incurred at a time. Whether it is allowable? Yes, it is allowable. Unless it is capital expenditure giving enduring value to longer life to the asset. In case where premises or building machinery, plant or furniture is partly used and not wholly and exclusively used for the business or profession, the deduction allowable under subsection 1 shall be restricted to fair proportionate part thereof as determined by the assessing officer. So basically, expenditure is allowable only when it is fully and exclusively used for the business. So whenever the exclusivity concept is diluted in respect of building use, etc., assessing officer will come to the role of disallowing on proportionate basis. What proportion? On what proportion? No definition, even earlier, even now. There is no. So that we leave it to the assessing officer. Let's not discuss. Then deductions relating to employee welfare. Employee welfare, contribution to provident fund, contribution to gratuity fund, contribution to leave encashment fund, contribution to pension fund. So accrual is the basis. Now accounting standard is also there, AS 15, where if employees gratuity is not funded, it is not allowable under section 43B. But accounting is based on accounting standard 15. It is mandatory to have it on accrual basis, where funding is also, whether accounting is also required and funding is also required. Unfunded liability is disallowed for the purpose of income tax. Then deduction in respect of certain premium, where assessee in respect of insurance against risk or damage or destruction of stocks or stores for the purpose of business. Earlier insurance on building, now insurance on stock also. And by the assessee as an employer through any mode of payment other than cash to effect or keep in force an insurance on the health of its employees is also under a scheme is also allowable. That means insurance taken in worker's name is also eligible for deduction provided is paid by the assessee. I am not covering bad and doubtful debts and depreciation because that itself is a lengthy chapter. Therefore, I am not coming in the way. See, most of the sections which I am telling is only earlier sections. Now it is given in a different class. That's all. Main part which we should understand all this expense is whether it is allowable or how much it is disallowable. That is a question which we are discussing. Already all expenses we have debited in P&L. The items which we are discussing is mainly whether it is allowable, whether there is any additional conditions, how much is disallowable. So one of the main points is, say earlier 40A2, payment made to relatives. It should be reasonable. Unreasonable sum should be will be assessed by the assessing officer. So here also same section continues, and relative definition is also given. There is no change in definition, therefore I am not elaborating. Relatives, payment made to relatives to reduce the income of the assessee is liable to be reported in Form 3CD also. Form 3CD there is a clause. Form 3CD also we have to report, and it will be any excess payment will be disallowed, but there is no what is called parameters set in the law. Therefore, reasonable or unreasonable will be decided based on the context in which it is paid, whether it is paid to reduce the income of the assessee or not is the paramount matter which assessing officer. Otherwise, mere disclosure is sufficient. Only thing is, if the amount paid to the relative should be declared in the assessment of the relative, that we should ensure. Otherwise, there will be some questions. Earlier, we have seen on section 43B. 43B is dealing with Provident Fund. It should be paid within the due date as prescribed in the Provident Fund Act, not within the due date prescribed in the income tax due date to file return of income. It is only for employer contribution, which is your expense. You have debited only that now. Employee contribution, you have not debited P&L account, there is no question of disallowance. Then, what is called interest and loan to NBFC or banks. So, mainly we should see in the context of NPAs, where interest might not have been paid even in respect of cash credit, where non-payment is very difficult to identify unless the assessee notices that is NPA, especially cash credits, etc., because it cannot be quickly decided by the auditor of the assessee unless it is known through what is called bank statement or bank's information that is NPA. It is classified NPA. So once it is NPA, then all interest unpaid should be disallowed under section 43B. And time lending institutions also is covered. Now from last year onwards, all you know, MSME unpaid sums beyond the due date to MSME is liable to be disallowed. That is a very lengthy topic. Of course, anything unpaid remains to be disallowed. Then amortization of preliminary expenses, it is continued as it is, but additional audit requirement like what is stated in the present 35D is not prescribed in new class. And therefore, separate audit may not be required, which I feel. But without seeing there is no prescription column, and therefore it may not be there. Likewise, scientific research expenses where capital expenditure is also allowable as expenditure, that continues. Apart from this, what is called deductions allowable under the heads profits and gains of business. We should see whether all SSEs should prepare P&L account based on the books of account, or is there any other alternative method? There is presumptive taxation is already existing in section 44AD, 44AE, 44ADA. So presumptive taxation, the same limit continues. There is no difference. One small difference is there in respect of, see now, tax audit is not required in respect of SECs whose gross turnover not exceeding 10 crore, where 95% of their receipts and payments are routed through banks. The present law is 95% of all the receipts and payments. In the new bill say 95% relating to the business transaction. So only 95% of the business transaction, only when 95% of the business transactions are routed through bank, audit is not required. Then in respect of turnover not exceeding 2 crore, 3 crore, now it is 3 crore. 3 crore where limit is there, 95% of the transaction turnover should be collected through bank, not receipt and payments. See, 10 crore where receipt and payments should be routed through bank, then only audit is not required. But in respect of 10 crore case, this 6% parameter, the estimate is not available. Audit is not required. Whereas 3 crore, 2 crore, 1 crore case, up to 1 crore, even when you don't have what is called 8% estimate, if you don't have profit and if your income is less than taxable, not exceeding the maximum amount which is not chargeable to maximum amount which is not chargeable to tax, then audit is not required even for small cases of less than 1 crore. But if it is more than 1 crore, less than 2 crore, you have to pay 6% if it is routed through bank, 8% in respect of cash transactions. More than 2 crore, up to 3 crore, you are eligible for estimate provided 95% of the turnover is collected through bank. Audit is not required. But up to 10 crore, audit is required, but estimation is not available. So, for small cases, we need not discuss elaboratively the auditing requirement and accounting standards, etc., because many small traders in bazaars may not follow all these rigorous accounting standards when they maintain books, when they do the trade. Certain special provisions for startups also is already in the existing law, but there is no special provision for startups in the existing law, but clause 140 is prescribing special incentive to startups, clause 140. Then in respect of certain what is called definitions relating to cost, etc., is very much relevant while calculating the profits, because depreciation is inevitable. Depreciation, conventional accounting method is not suitable to link it with our existing depreciation claim requirement under the Income Tax Act, and therefore always companies have different depreciation in the books than in the IT assessment file. Therefore, deferred tax liability or asset, as the case may be, is inevitable in accounting, which is necessary even for non-companies as per the present balance sheet format. Balance sheet format is already issued by the institute. It is already available, where deferred tax liability or deferred tax asset had to be counted. Now, very important provision which you should understand when we ensure compliance of tedious provisions. Tax reduction at source is mandated on businessmen. Businessman is on the victim side, because money is paid to either supplier or provider of service and is actually paid, but tax is not deducted. The question is, if tax is not deducted, then it is not allowable. Section 40A small ia old, that remains, that continues. without any. So, TDS should be deducted in respect of all assessees where tax audit is there. So, wherever tax audit is there, you should ensure tax is deducted sold in respect of payments. Some threshold exemptions increase is announced in the new budget, which you follow. But finally, tax not deducted cases is very, very vital while completing the income tax computation. One important thing in TDS, TCS on sales above 50 lakhs in a year was being taxed at 0.1% by the seller is going to be discontinued with effect from 1st April 206 C1H, where TCS is not required in respect of sales above 50 lakh to a SSC. So that is a very, very fortunate amendment, because people don't know whether tax should be deducted or tax should be collected, because many times tax should be deducted is a logical way. Why tax should be collected? Now it is being done away with. I think I have covered the main contents of the proposed income tax bill, profits and gains of business or profession, which is section 26 to section 66. The items which I didn't cover are mostly relates to exceptional items, which is relevant only for specialized businesses which require detailed understanding and preparations. In new income tax bill, in section 28, any other export incentives, a word is also included, gives a sense that any incentives which will be offered in respect of future schemes also will be covered. Because if you see section 28, every time whenever government introduce new schemes, import-export schemes, welfare schemes for exporters, that time or in the next year, through Finance Act, Income Tax Act is amended. Now there is a overall provision where any other export incentives also is brought under the Act. Then another important feature in the new bill is in respect of foreign exchange transactions, MTM loss, mark-to-mark loss is allowable irrespective of your method of accounting. That means expected loss based on your what is called derivative or what is called the swap deals, it is allowable. Basically, all contingent losses will not be allowed, but in this case, MTM losses are allowable. Then one clarity is brought in respect of capital asset. Accounting for capital asset, net of input duty, input tax, which is brought under clarity. But it is only option. Once you have availed input tax, then there is no question of claiming depreciation by capitalizing that part as cost of asset. That there is a clarity. Earlier this was a rule, but now it is clarified. Then in depreciation, one small what is called change. Depreciation on intangible asset is proposed to be allowed irrespective of its date of acquisition. So depreciation on intangible asset is proposed to be allowed irrespective of its date of acquisition. So 180 days rule is not applicable in respect of intangible assets in the new bill. Then in respect of investment linked expenditure, a taxpayer is eligible to claim investment linked incentive under the present act, wherein 100% deduction is granted on capital expenditure incurred with respect to specified business undertaken by the taxpayer. Further, if the capital asset is sold, the sale proceeds are fully taxed as business income. So whenever 100% depreciation investment allowance is availed, then when it is subsequently sold, the entire sale proceeds is subject to income tax as business income, which is clarified now. Because earlier, whenever investment allowances are claimed, in accounting it is not credited in the profit loss, credited in the asset to arrive WDV. It is kept as investment allowance reserve, etc. So when it is sold, it will be credited to the asset account in the books of account. So immediately profits under the income tax assessment cannot be calculated. So now it is made clear that whenever investment allowance 100% benefit is already availed, sale thereof is liable to be fully taxed. Then one important thing which see minimum alternate tax, section 115 JB. Section 115 JB, intercorporate dividends are eligible for deduction to arrive tax under minimum what is called the tax under 115 JB. Now no such deduction is proposed in the new finance bill. Therefore, that clarity should come. Intercorporate dividends are also liable in case of investment companies, especially investment companies where sister company, subsidiary companies will give dividend to the holding company. Holding company has to pay tax because and in the new law there is no clarity of what is called carryover of carry forward losses in the successive years. So unless specifically mentioned that all carry forward losses under the existing law will be allowed as for set off in future years as per the original provisions under the present Income Tax Act, that particular carryover is under risk. By and large, I could understand from the new finance bill, the income tax bill with the existing Income Tax Act, as far as profit computation is concerned, there is no significant change. But I understand from the what is called new formats prescribed by the Institute of Chartered Accountants of India for non-corporate entities. Almost all the non-corporate entities which are liable to be liable to be covered by tax audit, is bringing more disclosures, and profit is calculated very much within the four tenets of the laws, especially income tax law, except depreciation and other what is called 43B adjustments. Now 43B adjustments or 40A adjustments are depreciation adjustments. Subject to that, profit should be accurate. Earlier, because of what is called no prescribed format is there, and therefore horizontal format was following by our elders, and vertical format without the figures for the previous year, and without the all 11 columns relating to related body transactions are capital disclosure. Capital disclosure is now very clear, because all additions you should clearly show it as addition, and drawings should be shown as drawings. In respect of partnerships, you should show remuneration, interest, share of profit, addition. If additional capital is brought in, you should separately disclose. That is a standard capital disclosure formats. But at the same time, we, the members, are not uniformly following, because there is no prescribed format. Now it is brought out, there is a format. You should give the information only in that particular format. So netting many times may not be possible. Cash introduction, cash drawings, net may not be possible through this format. So format which you please study, it will be very much useful. I have given formats. 1 minute. This is a format which you please look at. I think it is not visible to you. Hello? ഇത് കുറച്ച് വലുതാക്കുമോ? So this is partners capital account disclosure. Now share of profit, opening balance, capital introduced, remuneration, interest, withdrawals, share of profit, closing balance. കുറച്ച് വലുതാക്കാൻ പറ്റുമോ? പെരുസാക്കാൻ പറ്റുമോ? And notes forming part of accounts is very important. Related party information is very important. Through related party information, if you give related party information in this financial statements and not giving in Form 3CD, then it will be under question. Earlier, that particular requirement is not there, and therefore, in respect of non-corporate entities, balance sheet may not contain all these particulars, and therefore Form 3CD, whether it is full and complete, nobody knows. It goes. Now in balance sheet you have to, so this balance sheet in the prescribed format with the figures for the previous year and giving narrative disclosure in respect of related party information, significant accounting policies, and other important narrative notes are becoming. It will make accounts comparable and uniform in the coming years. With this, I open the session to audience for asking whatever questions relating to balance sheet presentation or expenditure disallowance or income inclusion, etc. Whatever questions you please ask, to the extent possible, I will share my knowledge.
Format are prescribed under the new bill or the CA Institute?
CA Institute guidelines.
Is there no relevance the
No, but profit should be calculated, no? See,
what I'm asking is that
no, it is not given in the new bill. It is not given in the new bill, but the profit should be calculated. Say earlier we are preparing profit and loss account, but that profit and loss account now for non-corporate entities you have to prepare in the prescribed format. That is the only change which I am focusing.
does the new bill say that it should be prepared and in line with the CCA Institute guidelines?
That is not there.
Income tax bill.
No.
Whether the earlier rules is to be followed or new rules not there?
No, new rules will come. Will come. Because see, when Companies Act is sailed more than a decade as a bill, and finally Companies Act came in 2013. Then over the 4 or 5 years, now rules are more in Companies Act. Earlier rules are relatively less. Now in Companies Act rules are more. Like that rules are inevitable. Rules will come. No. I am what is called optimistic, but at the same time, I don't think income tax bill will come as quickly as possible. If at all it is coming in the statute book, it will be notified at a later date, and rules also will become come at a later date on a phased manner only, because even sections under the new bill will be implemented in a phased manner. 172, section 72. But it cannot be quickly implemented, no? Like that, the Companies Act also is implemented in a phased manner. Likewise, LLP also. LLP Act also is Act is brought out and notified in a phased manner. So rules will come. Rules are inevitable. And in the new bill, I understand CBDT is given more powers in relation to giving what is called TDS and TCS related matters, and what is called giving clarifications. Nowadays, now also it is CBDT under section 119, powers are there, but the powers are taken from the respective sections only. Now more powers are enshrined to CBDT. Of course, they are executives, only from the law they can trace the powers, but powers are relatively larger. Now 5 years they are ensuring. Then the 5 years the condition is stipulated, and therefore once you opted, then you cannot come out. Because many the people who opted in the normal what is called calculation with audit, they are not allowing. Once you opted for what is called 6% or 8% scheme, then you have to continue for 5 years. That is a statutory condition. Because your accounts are not looked into now. Therefore, in 1 year you may be earning more. Say 1 year you are earning 15%. Another year you are earning 5%. Another year you are suffering because of this. The law is not permitting. Because law is not entitled to look at your accounts, no. It is strict because the assessments are also coming by disallowing subsequent shifting without mandate. Any other query? Because in accounting standards, the youngsters should bring more queries, you know. It is for future. But in the new law, it says it is allowable irrespective of the what is called irrespective of other provisions. No, MTM losses, you can adjust because of the new bill. In old scenario, MTM losses are not allowable because it is contingent loss. Therefore, based on your accounting standard, it will not go. Because if it is inventory, okay. If it is what is called derivatives or swaps, it is not allowable. But now say MTM, because based on the RBI guideline and FDI mandates, etc., it is about the accounted thing, because only based on FDI guideline, the MTM losses is accounted in the bank's books. So once it is accounted in the bank's books, why participant books also it cannot be accounted? If I am liable to pay to the bank in respect of my what is called derivative gain, derivative loss or any other what is called off balance sheet items, then why I should not account is the question. Of course, it is a commitment only. I didn't pay. I have given only token charge, but there is a loss, and therefore that is allowable in future through bill.
No, sir. I couldn't get to. So you are explaining that it will be allowable. Like you are saying that it will be allowable. So
it will be allowable.
Yeah, you are you are trying to explain it will be allowable in future, right?
In future, not through existing law. IT Act is not allowing.
Yeah, through deferred tax you are trying to say like that. Like it will be accounted in financials, or I couldn't get to, sir. Sorry.
See, in respect of MTM losses, at present, it is not allowable for income tax purposes. Okay. Hereafter, through the income tax bill 2025, it is allowable. It is allowable. There is a change. After Finance Act, the income tax bill is enacted and implemented. They say 1/4/26. We will see, because there is no urgency for the parliamentarians to bring this.
Okay, sir. Thank you.
Okay. Now itself, about 10 ICDS is introduced by the income tax. So mostly we should follow, and deviations between the years we should disclose in the Form 3CD. And whatever affecting the profit is liable to be included in the profit, and we should pay tax for that. Now we have more accounting standards, more accounting standard to be followed for the purpose of this what is called the formatted financial statements. Formatted financial statements, level 1, level 2, level 3, level 4 entities. So in respect of level 2 entities, which is following 10 standards as per Income Tax Act, is not sufficient. It should follow entire 29 standard. Exception is not available. No. Now, whether it is mandatory is the questions are asked. Whether it is mandatory is the question. Now, shall I certify? How can I certify? That is the question. Then, once it is certified, can I exclude these items in the computation, mentioning that? So that is the question. So the accounting is becoming more relevant. Therefore, I started with the saying section 28 where starts with profit added by. Adjustment. It is only adjustment is being talked about in section 26, earlier 28. Now, the very first profit is guided by our financial statements. Of course, for corporates, Schedule 3 is already available. For corporates, we are guided by Schedule 3. No exclusion. But we have large number of individual proprietors, having 10 crore turnover, 20 crore turnover, 15 crore turnover, 7 crore turnover, no? They have to follow. Even under level 3 the formats, we have to proceed, Therefore, that is becoming vibrant for small practitioners, chartered accountants who are doing level 3 entity audits. Of course, level 1, it is listed entities, banks, insurance companies. Level 2, large companies having 250 crore turnover, more than 50 crore and less than 250 crore. Okay. Anything else? Thank you very much for your kind attention and patient hearing.